A very warm welcome to everyone present here for today's GST ki Pathshala session. We are excited to continue our learning journey with yet another insightful and highly practical topic. To lead this session, we are privileged to have with us distinguished professional CA Nandini Gupta ma'am. CA Nandini ma'am is a partner at HNA and Company LLP Pune. She is qualified as a chartered accountant in 2018 and has been associated with the firm since 2014. Over the years, she has played a key role in handling GST audits and consultancy for a wide range of industries such as logistics, real estate, hospitality, and the automobile sector. Her contributions to professional knowledge are commendable. She has authored the booklet Tips to Effect Tips to Draft Effective Opinion and has also assisted in important publications including Compendium of Issues and Solutions in GST and Handbook on Central Sales Tax. She is also an experienced speaker, having delivered lectures at prestigious platforms like ICI, MCCAI, Hiregange Academy, and several other trade and professional forums. With her rich experience and technical clarity and practical approach, today's session promises to be extremely valuable for all of us. On behalf of Pune Vikasa, I extend a heartfelt welcome to CA Nandini Gupta ma'am and invite her to take over the session on annual return audit and reconciliation. Over to you, ma'am.
Thank you, Vaibhavji. It's been humble of you to share few words about me and the professional pathway for me. Firstly, good morning to all. And today's session, as rightly said by Vaibhavji, it is going to be on annual returns. I'll just share my screen, Vaibhav. If you can just confirm if it is visible, then I would take it ahead.
Yes, ma'am, it is visible.
All right, thank you. So, firstly, just a background of it. Annual returns way back in 2017-18, we had four extensions, I think, for 17-18, and after that, we had to file the annual returns, and that is the time limit or the time gap we as professionals and we as students had got. As of now, the annual returns is in 2.0, or I would tell 3.0 after last Friday, with continuous changes in the forms within the same year. Till now, no extension has been announced. So, considering how the forms are pushing the professional to understand what is the perspective of department, what is the perspective of the department analyticals. So, in the past, what is happening is the annual returns was sometime considered to be a summation of the returns. Then it went ahead and understood as analytical skills. Then the signatures went away with. Then the departmental analytical started, and then the forms itself started getting amended, revised, with certain tables also being introduced this year. So, while this is the background, we really need to understand what is the change is one part, why is the change, and how the future litigation and the future departmental analysis on the same, or even the perspective about the client, and if anybody sees their annual returns, will change. And this is how the annual returns is evolving. So, it's a very important topic and it's a need of the hour for everybody. 31st December is still the due date with no extension being announced. So, in this background, considering very high importance about the subject and the need of the hour, I think we'll deliberate on various issues and various analysis which is required to be done by anybody before filing their annual returns. Right. So, firstly, the entire GSTR 9, the anatomy of it, if I see, it's broadly, yes, this time also it is divided into two major parts, basically the part 2 and the part 5. But if I look at the part 2, broadly what the instruction is trying to tell us, okay, disclose anything which has happened within the financial year of 24-25. However, there are certain key tables where the FAQ and the instruction is come up and told within part 2 there is going to be two parts. One is last year which is considered this year, and this year within the year which is considered this year. And part 5 is exclusively this year, which is a part of the next year returns. So this is the broad anatomy of the structure of annual returns which is done for this year. Let's see certain key important elements when we look at the annual returns. Yes, for this year also the turnover criteria is 2 CR for a minimum applicability of GSTR 9 and 5 CR for your 9C. Can I file my 9C if I do not cross the threshold of 2 CR? Yes, you can. You would want to, you've already missed your rectification on the disclosure parts. So if there is any disclosure rectification, still you can file your 99C and still take a view of, the disclosure rectifications which is already done and shown to department, so that you're not under any of the 74 notices at least. Okay, we'll go ahead with certain key reconciliations for the annual returns. Before we go into various tables, various checkpoints, a base of the entire annual reconciliation is this particular slide. Okay. So when we start our reconciliation, what is our first starting point, or what is our first thumb rule? Our annual financial statements has to be signed, be available with us for the further review. Now, when I come to the turnover reconciliation, it is not only a turnover of the operation income, including other income, miscellaneous income, any other income, where total income of the financial statements, a base data of the entire uh, revenue, I would say. So, in my view, please take the entire revenue ledgers from the client as it is, entire revenue ledger matching with the financials at line level. This has to be your top first line of review. Then, if it is a multi-locational client, if it has got a states which is more than one state, say Maharashtra, Tamil Nadu, Karnataka, Gujarat, it's got a multiple states, then please ask in your revenue ledger itself what is the state in which this revenue is belonging to as per our books of accounts. So it is as per our books of accounts, as per the base data which is there, which state this revenue is belonging to. Then you have a clear breakup of your gross total turnover as per your books of accounts split into various states. This is your first step and very, very important step. Then the second step is to understand the reconciliation of this line item versus your GSTR 9. Now, what is your GSTR 9? How it is going to be developed? We'll again discuss about it. Is GSTR 9 a consolidation of my GSTR 1? Broadly, yes, but still we need to understand whether the payment of the same is also done in 3B of this financial year. Let's take few examples. A revenue of a financial year 23-24 has been paid in 24-25. Should it be a part of the GSTR 9 of this year? The answer is still yes. People have taken interpretations and review that it was already a part of the table file last year, then ignore it here. This view is also possible, and the unreconciled difference has to be explained. That's the only view which is there. So as of now, if we are taking a view that entire revenue which is there in your R1, which is paid off in GSTR 3B of this year, if that is forming a part of your GSTR 9, then you have a clear base. Your books of accounts and your returns on which the taxes are paid in 3B within the year, these both can become comparables. Now do your reconciliation. Unless and until you have this base, do not perform any reconciliation. So, three things. One is a breakup of your turnover as per your financial statement state wise, or if it is a single state, the entirety. Second is to understand the GSTR 1 versus your GSTR 3B. If it is paid within the year, then these both becomes comparables. One will go to your GSTR 9 and the other will go to your GSTR 9C, and this will form a base of your turnover reconciliation. Right? Next is to understand whether at all whatever is there a part of your GSTR 9, which is your taxable, exempted, nil rated, rate wise analysis, and all those things. So, those analysis do it at a later stage. This is the summary of it. Next, output tax liability. Generally, what is done is there is a reconciliation which is always done by most of the people, which is a turnover to a turnover in GSTR 9 and 9C. What about the output tax ledger? Say your client is already triggered a liability in their books of accounts. However, the same is not paid in your GSTR 3B or not disclosed in your GSTR 1. How is it impacting them? Do we even need to review it? The answer is yes. The liability ledger of your books of accounts versus the liability which is paid in your 3B, do the second reconciliation of the same. This will give you a picture as to understand if it is a self-generated liability in your books but not paid in 3B, then a suggestion of your DRC 03. Second, okay, the liability in the books of accounts also is not triggered, but in 3B whether it is paid. Then understand why it was paid, whether it was excess paid. Then you have a clear base of your review and your analysis. Then we have, if anything, any liabilities which is there in your books already paid in your DRC 03, whether this should part a form of GSTR 9. Answer from my view is yes, it should still form a part of your GSTR 9. It was a part of your turnover. The government have been received taxes. Why it should not form a part of your GSTR 9? It should form a part of your 9. However, there are certain tables which will have differences, and for that difference, definitely you already have answer of your DRC 03. So we'll then understand at a later stage as to documentation, where do we put it, how do we put it, right? The next important table is your rate wise analysis. So now we are our turnover, then we have our taxes. Once these both are freezed, the next stage is to understand the rate wise analysis. Here also I would tell, do a two-way analysis. One is to understand whether at all the rates which are paid off in GSTR 3B, the same rate or the same ledger is triggered in your books of accounts, or whether there is a wrong rate trigger which is there in the books of accounts. Of course, in the above tax liability ledger, you will know the differences, but now you will know the rate wise which ledger has a difference. Next is to understand the second way of reconciliation is to understand. Here again, a three-way reconciliation. First, understand the goods, understand the services, then link it with your HSN, then the rate of tax. How people have derived this entire review is, what is your HSN? Whether as per HSN the rate of tax is there. No. First, you should understand whether the goods or services HSN itself is right. And if HSN is right, then the rate of tax. So do not have that shortcut as to HSN to rate of tax. If there is a time constraint, understand what alternatives, understand to inform limitation, keep people informed, put it on record. Do we want to do a review of the classification issue in January? But put it on record. So keep yourself clean on this is a thought process I would want to share. Then, of course, by this time we would have already done our 1 versus 3B reconciliation. If there is answer is yes, there is a reconciliation difference, there could be two issues, right? A liability of last year, only disclose it this year but paid off in the last year. This is one issue. Second is, okay, liability of this year which got rectified or amended through a B2BA or a B2B to B2C, whatever is the amendment in the next year. Third, liability of 24-25, which is paid off in GSTR 3B of this year but a part of R1 this year. All three bifurcations, let's understand what is the disclosure mechanism. Liability paid off in 23-24. Liabilities paid off in 3B of 23-24. Okay. Only R1 disclosure in 24-25. Do we show it in GSTR 9? The answer is no. It could have already been a part of your GSTR 9 table 2 of 23-24. So this year it is only there in R1 and not there in 3B, not there in books. Do not show a part of your GSTR 9 this year. Second issue, a liability of 24-25 which is paid off in GSTR 3B of 25-26. It should form a part of 9 but a part 5. It should form a part of 9 at table 10 or 11, which is a debit note or a credit note or an amendment or a disclosure in the subsequent financial year. Right? So it is a next year disclosure, that is why it's a part 5. Next is changes in B2B to B2C or amendment of GST and numbers, all those things. Will it have an impact? To the extent where the category of tax, the type of tax, if it is a CGST and it was CGST, a change from B2C to B2B or a B2B to B2C is not going to make a difference unless and until it is within the financial year. Say a last year B2C was amended to B2B this year. Should it form a part of your GSTR 9? The answer is still no. Only if the change is triggering a liability in 3B, then check the impact of the same in GSTR 9C. If the triggering or the change in the amendment is not triggering any liability in your GSTR 3B, then it should not form a part of your GSTR 9. Third, if it is a change of amendment where a 100 rupee amount was updated to 120, so the 20 rupee change will have an impact in your GSTR 9, but whether it should form a part of your part 2 or part 5, decide in which 3B it is paid off. If it is paid off within the 3B of the 24-25, then it will form a part of your 24-25 GSTR 9. If not, it will form a part of your part 5. So when you're doing the 1 versus 3B reconciliation, understand two things. One is that if there is an indifference, then the difference is creating a triggering point in 3B. If it is triggered, in which year 3B it is impacting. So this should become your deciding point as to whether it should form a part of this year 9C or this year 9 part 5 or the next year portion itself. Clearly? Next. Well, this is the base of your outward reconciliation. This has to be there, without which, if you develop any more details in your annual returns, it is going to be entirely amount mismatch, amounts are not matching, there is a difference, then identification of difference is going to be difficult. Right? There are certain portions on the ITC I would touch at a later part of the session. Okay. The next portion of the outward tax is to identify a category. What is this category? I mean to say, whether it is a B2B, B2C, whether it is a zero rated with payment of taxes, whether it is a SEZ with payment of taxes, whether it is a deemed export, whether it is a credit note to a B2B, whether it is a debit note to a B2B, whether it is a credit note to a B2C. These are certain categories which is there in the outward tax table of your GSTR 9. So now we have our turnover, now we have our liability of taxes, and we know the rate of tax. Now we need to classify which type or a category it is a part of it. Few important questions. If it is a credit note of a B2C, the form instruction is very clear. If it is a negative amount in B2C, it should be a single line item as a 4A5, that is outward tax liability. It should be merged. Say you have a B2C of 100 and you have a B2C credit note of 20, then your 4A is going to be 80 rupees. It is a single line item. That's all. Okay, so still now also it has to be merged. So consider and ensure that it is merged and disclosed. Next is supplies made to registered persons, which is a B2B. Few important questions we again are going to speak over here. Whether an amendment from a B2C to B2B within the year should change from 4A5 to 4A to 4AB, the answer is yes. whether a B2B to B2C amendment of 23-24 has to be changed from 4A to 4B this year, the answer is no, because it did not have any triggering point in 3B of this year. It should not come in a part of this at all. Next is to understand zero rated supply SEZ. So anything which is with payment of taxes which is done within the financial year then will come in 4C and 4D. Then deemed exports. Deemed exports and merchant exports are two different categories. I've been struggling to explain this concept to multiple people, so I thought I'll bring this up. Deemed export is coming from a specific notification which has only four categories. Example is a supply to an EOU. It's a deemed export. Second, if we do any disclosure in deemed export, whether it is also shown similarly in your GSTR1 is a checkpoint you can do. In your GSTR1 while you're filing, there is a checkpoint which you can do. The checkpoints are liable under reverse charge, liable supply to SEZ, deemed exports. These are certain checkpoints you can do it in your GSTR1. First, when you disclose in your deemed export, check whether if you have done disclosure. If you have not done disclosure and disclosing directly in your annual returns, put on your record that there is a reduction in B2B but a similar increase in your deemed export. So please put it on your record, and in my view, ensure your working paper is watertight for this particular disclosure change. This is important, okay? I'll tell you why. Department data analytics is going to be based on numerous reconciliations, and one of the reconciliations is definitely to understand whether you have dipped your turnover in your B2B while you have shown a higher portion in your GSTR1, or whether there's an increase in your B2B while there is a dip in your GSTR1. So these data analyticals is going to be triggering point, and there's a call for information notice which you generally get. To ensure you have quick, effective answers at that point of time, your working paper needs to be watertight at this particular place. Okay. Next important one is advances on which taxes are paid but invoice has not been issued. There are two things, right? In GSTR1, there is an advance, there is an advance adjustment. Both the things happen. Say in an entire year, a client would have paid advance of say 10 lakhs rupees. Okay, and in that he's adjusted say 6 lakhs rupees. What 4F should appear is only 4 lakhs rupees, which is the balance 10 minus 6, which is the outstanding advance pending to be adjusted. While the instruction is very clear, it says advances on which tax have been paid but invoice has not been issued. For whatever is advance adjusted, definitely there's an invoice which is raised. So that will go a part of your B2B, and it should not again have a duplicate impact in your 4F. Right? I hope I'm clear by till now. Then there is a important change or a disclosure which says supplies on which e-commerce operator is required to pay taxes, which is 4G1. This is a new table, a new liability which is a liability table which is increased. So we all knew for any of the supplies which is done for aggregator model, especially hotel accommodation, these levels, sorry, not accommodation, hotel supply where there is a food through a restaurant, then the liability was shifted from the hotels to the e-commerce operators. So there the e-commerce operator is liable to pay the taxes. However, it is a tax of the hotel which is paid off by the e-commerce operator. So it is a turnover of whom? The restaurant. But the liability is on whom? The e-commerce operator. So there is a change. The taxable value of one person, the revenue of one person, but the GST payment is from another person. So this 4G1 was a need, and that is why they have given a separate particular table there. Next is credit note issued. A credit note of anything between 4B to 4E. Any credit note has to be categorically provided in 4I. Earlier we had this option, credit note disclosure you do not have to do separately. It can be a part of your B2B itself or the zero dated export with payment. It can be a part of it only. So like B2C, what presently is there. Similarly, there were other category where you could have merged the invoice and a credit note. As of now, there is no option. The option is removed. So the credit note portion has to be indicated separately in the form other than B2C. That's all. Keep in mind only that. Then we have the debit note issued in respect of certain transaction. Okay, few issues which I foresee over here. Many a times in books of accounts for accounting treatment, if there is any penalties, if there is any short services of the vendors, a debit note is raised. Now, this debit note is an indication of collecting certain taxes in accounting terms from the vendors or an exception item. This is not my revenue, but I'm going to collect taxes. So, debit note is raised. Now, this is actually not a debit note in terms of GST. What is a debit note in terms of GST? It's very clearly it says our original supply was X, but determine it to be X plus something is a debit note, including the supplementary invoice. This is how a debit note is being considered in GST. So any category of a debit note in your accounting, which is actually not a debit note for the purpose of GST, then think and reclassify it in B2B. And for the future, suggest your client not to put it in the debit note category because it is not a debit note but an ideal original invoice by itself. The issue of analyticals of debit note is to understand which is your original invoice, understand why there should not be an interest which is liable from the first day onwards. This is how the data analyticals for the debit note is there. So if there is a debit note, then you clearly understand if there is an original invoice. If no, then understand whether it was a B2B, but actually a debit note document was wrongly selected per se. Okay, understand this, and this is very important for your debit note disclosure. Next, I thought one more, we'll just go back to credit note. I think one more important aspect is while you do your credit note analysis, three four things is something which I would really inform people to check the way future departmental questions or queries or to safeguard the assessee. These are important. One, definitely I'm sure many of us do this, to understand every credit note issued is within the time limit. Of course, there is a delinking of a credit note to its original invoice only on the GST portal. It is not delinked in your legal or the GST law itself. So, any credit note time limit check has to be there. So, credit note to a original invoice, whether the original invoice was more than or equal to the credit note. This is, please do this a second checkpoint. Next is to understand whether the same customer was given the invoice but wrongly tagged to some other customer in a credit note. So this scenario also are appearing. So ensure to check this. Next is to understand whether there is a rate of tax which is changed in between the period. Say while issuing a tax invoice, say it was 18%, while issuing a credit note, the rate of tax for the said category, if it is higher, then you are in trouble. You cannot have a credit note which is beyond the invoice. Similarly, if there is a reduction, then there is a loss from the client side. If there is a reduction, say 18% was the invoice, 12% is the credit note, then there is a wrong excess payment of taxes to the government. So these two checkpoints you need to do in the credit note. Third and foremost important checkpoint, if it is a credit note towards a goods, understand two things: whether it is a goods which is returned back, or whether it is a discount which is provided in terms of volume discount or a trade discount or early payment discount, anything. If it is a category 1, which is a credit note issued for the goods which is received back, then please check internal working papers whether there is an e-way bill for the goods which is received back, whether there is a lorry receipt for the goods which is received back. Not receiving back the goods but still issuing a credit note is a clear violation of section 34. You cannot issue a credit note when the goods are not even returned back. There can be categories which are credit note issued where it is removed to a third person from the place of your assessee itself. Then also it is okay. It is equal to receiving back and supplying to somebody else on for on behalf of from our side or from the assessee side. But in your credit note, you need to check if the goods are received back, then what is the documents you have for your goods which is received back. Similarly, if there is going to be a discount because of which there is a credit note which is raised, then please check back one more aspect whether it was a pre-agreed discount or a post-agreed discount. With all this impacts of the credit note, last leg of the credit note checkpoint is your IMS. Now, IMS as a aspect, people have taken it a different understanding. Few people have adopted, few people have not adopted, few people have considered it to be legally not binding, and then all of it is yes. Somebody who feels it is ease of the our adapting, they have adapted it. Legally, whether it is binding anybody, the answer is still no, because the rules are not yet out, and to challenge the only act being in place, it's still yes, it's legally possible. But for the year of 24-25, your customers could be considering IMS. So if you've raised a credit note and there is a rejection, at this point of audit, please check who has rejected, why have they rejected. Communicate to your clients and tell them there is a credit note which is there in your annual returns but has been rejected by your customers, and it is clearly visible in the IMS dashboard. So this is a wonderful opportunity to understand, check, review and intimate your clients. Okay, if there is a credit note and it is rejected, then what do we do? Is a second leg of communication. In my view, if it is by mistake, then please take it on record and keep it. That's all. And take a confirmation that they have reversed the ITC but by mistakenly rejected. Second, if it is a genuine rejection from their side, understand whether they've already made payment. If yes, then you really need to think in your annual returns. Okay, then should we pay off the taxes back through a debit note, disclose it in your annual returns, and pay it off a DRC 03? Whether a non-payment or whether a payment through a DRC 03 will trigger a ITC rejection or an ITC reversal to the recipient, the answer is no, because in IMS you already shown the taxes and it is rejected by your customer. So a credit note rejection is still okay, but ensure you take actions in your annual returns. Okay. Then last and foremost, we have two more important tables. It says supplies or tax declared through amendments, or a supplies or tax which is declared through amendments, positive or a negative. This K and L could be in most of the cases not be existing. The reason is your e-invoicing. Your e-invoicing does not allow you to amend an invoice on a plus or minus. It allows you only to cancel or full credit note and a full invoice. However, for somebody who really has it, who's not within the e-invoicing category or has an e-invoicing category but still done amendments, then appropriate disclosure of 4K and 4L is relevant. I think these are the broad tables which is very much relevant for table 4. I would take a 5-minute pause and answer any, or 2 minutes pause, in fact, answer any questions which are there, if any. Okay. My screen is visible back, right, with the PPT. Vaibhavji, if you could help me.
Yes, ma'am, it is visible.
Okay. So I don't see any questions which is yet put up. So if there is any questions we'll take it at a later stage of the session today. And we go ahead to the next outward category, which is a outward supply. With this, no taxes with on it. Okay, few specific categories: a zero rated supply without payment of taxes. So, like we saw in the table 4, anything which has taxes are going to be a part of table 4. Any outward supply which is without taxes is going to be a part of your table 5. Now, how important was your table 4 was to understand whether the liability exists, whether there's a correct rate of tax, whether there's a correct type of tax which is paid. Similarly, your table 5 analysis or a technical review should form and understand whether at all it is an outward supply which is a valid statement to tell it without taxes at all. We'll take few examples. A zero rated supply without payment of taxes. It can be a supply of a service or a supply of a goods. If there is a supply of a service for which a export consideration in foreign currency is not received till December 25. It is a part of your outward supply of 24-25. Say it is a supply done in April 24, but an export consideration for an export of service is not received till December 25. While you would call it as a zero rated of supply without payment of taxes, we should also understand why the consideration in foreign currency is not received till December. Whether there was an RBI extension which was provided because of which the foreign currency is receivable and will be received at a later period of time. Whether any return offs or write backs is done in the books of accounts because of which we are considering it to be a part of this year revenue. Then whether it was up, okay, I'll just slow down and explain it again. Say there is a write back of customer ledger in this financial year in foreign currency. Then should we directly disclose it in zero rated without payment of taxes, or should we ideally see in which year it was written off, in which year the ideal supply was, and what was the deliverables? In my view, because it is a write back of this year, still we need to understand what is the history of the transaction and check back whether it was actually a zero rated export without payment of taxes. Can we fall within this category? Okay. Similarly, for goods, actual goods going out of India, that is very important to call it as export. So whether there is a export manifest or whether there is a bill of whether there is shipping bill which is very clearly indicating that the goods moved out of India is very important to check. Next is supply to SEZ without payment of taxes. Right now, whenever there's a supply to SEZ, there is a checkpoint which is done by the departmental officers to understand whether in the SEZ portal of the customers, of your client's customer, whether the supply is visible to be received. This is one checkpoint that can be done on your SEZ portal. So you can also do it and keep it on record. Second is to understand whether there is a SEZ officer endorsement on the invoices. This is another important checkpoint people have been asking for. Why? To understand if the goods which are sent are actually used for the authorized operations and within the SEZ. To understand this, the endorsements are becoming very more important for the department officer to understand and confirm that okay, this is a liability which is there, but liability is not there anymore because it is an SEZ supply used for authorized operations. So the endorsement certificates and the check on the SEZ portal are very important aspects over here. Next is a category supplies on which taxes to be paid by the recipient on a reverse charge. A classic example is a goods transport agency. It can have a outward tax liability under the reverse charge, right? So if it has, then on which taxes are not paid by them but on the recipient, it will not go in part of table 4 but a part of table 5. In their GSTR1, there could be a liability at 5% which is disclosed, but the triggering point there is payable by the recipient, because of which it is not their own output tax, so it will not form a part of your table 4, but it will form a part of your table 5. Next is supplies on which tax is to be paid by e-commerce operator as per 9, paid by 9 as per this. So this is while we spoke about the hotel category, say there's a hotel or a restaurant, it has its own turnover, but the taxes are not paid by them but by the e-commerce operator. So the e-commerce operator will put it in the table 4 and the hotel or the restaurant will put the same turnover in table 5. So I hope it's clear. Next is an exempted, next is a nil rated. So any category of your goods and services, while we putting it under exempted or nil category, be very sure. Be very sure and understand if really there is an exemption or if there is a rate which is at 0%. Only then you categorize this. Few examples, it could be there in most of the RCC's books of accounts. Interest income. Interest income in the form of interest on capital, interest on loan, interest from fixed deposit, interest on term days. So these are interest income which are not a transaction for supply within GST. So it is very well, interest income is exempt. There's one more category of interest which the client could get. Interest on delayed payment received from customer. So, if section 15 clearly says it should form a part of your valuation, and because of which, if it is put in table 5, it is wrong because there is a liability on the same and it has to be moved to table 4. And whether the liability is paid or not in 3B is your checkpoint. If it is not paid, then ensure you inform to pay it in your DRC 03. So this particular table 5, D and E, which is nil and exempted, is clearly ensure, recheck and double check. If it is clearly exempted and nil, only then you put it under this category. Next is non-GST supply. A classic example is sale of land. This is Schedule 3 category. So whether it's a supply, no, but it is a part of your turnover, yes. Because of which, instead of putting in your reconciliation part of your 9C, from 21-22 onwards, it is a compulsory table. You need to put it in your non-GST supply. Any credit note or debit note for the above, or any amendments or amendment up or down for the above, is also a separate disclosure at this particular table. Do I have an option of merging the credit note, debit note, amendment category to the particular table of 4A, 4B, 4C? You can still do it, there's no harm in it. But non-GST supply, exempt, nil, these categories have to be separately indicated and it's a compulsory one. While we do this particular table, we also need to understand one other important aspect. Whether there is any expenditure incurred to supply these category of outward supply. Excepting for an export, any other supplies which is done in this particular table 5 should also trigger your ITC reversal. Should also trigger your ITC reversal. Why? A proportion of your business has an outward supply which is without taxes. Then any expenditure on the same should also have a proportionate reversal of ITC. So while we do this table, we should note Okay. So this table 10, which has 14 items, which is sorry, table 10, which is a part 5 of your GSTR 9, is the next table of your outward supply, which you also need to consider. Say table 10 has outward supplies declared through an invoice or a debit note or amendment of the next financial year. Whether a credit note which is issued in 25-26 for a invoice which is dated 24-25 should form a part of this, answer is no. Then what should form a part of this? A credit note which is dated 24-25 but not issued within the financial year of 24-25, which is uploaded or impact taken in 3B of 25-26, then it will form a part of your table 10 of your GSTR 9. So the credit note date also is important. If it is a credit note date of the financial year which is not disclosed or not taken impact within the financial year, only then. But if it is a credit note issued in next year for an invoice which is linked next year, then this credit note will not form a part of this year disclosure but a next year independent disclosure by itself. I hope it's clear and not confusing. Similarly, a debit note which is raised in the year of 24-25, which is not uploaded or not paid off in the within the financial year of 24-25, only then it should form a part of your part 5. If it is a debit note for an invoice, debit note of 25-26, which is linked to an invoice of 24-25, then the debit note will not form a part of your part 5 but next year. So the date of your credit note or date of your debit note should become your deciding factor to understand whether it will form a part of your part 5 or no. Right? Then we go back to one more important table. This year this table is updated. Whatever we discussed till now, a deciding table to intimate government that the said taxes are paid to government and in what way is explained in this particular table 9. Tax payable versus paid. This is called table 9 of GSTR 9. What it captures is very, very important. A tax payable is generally triggered from your table 4. What did table 4 have? It had all output tax liabilities on which tax is paid by the client. Plus, it had one more important item, a tax which is self-paid under the reverse charge. Because it is self but still paid, it is forming a part of your table 4 of your GSTR 9. What happens here is, say you have an output tax liability say of 8 lakhs and you have a reverse charge liability on which you have paid an output tax of say 4 lakhs. So the total tax payable in the tax payable column is going to be how much? 12 lakhs. Of course, the reverse charge item is going to be paid in cash. Say this is 4 lakhs. Plus a little bit of 1 more lakh, say it was paid in cash. So this will become 5 lakhs. So 12 minus 5, the 7 lakhs differentiation is going to be paid through ITC. So the table will capture output tax liability of 12 lakhs, paid through cash was 5 lakhs, paid through ITC was 7 lakhs. The entire 12 lakhs is paid, yes, it is paid. So this difference, total tax paid, and the difference between tax payable and tax paid is a clear capturing table over here. So this last column, difference between tax payable and Okay. So few more examples. Say output tax liability was 12 lakhs, and after your 990 review, you understood, okay, 50,000 rupees also needs to be paid, and it will, and the as client is considered, okay, we'll pay it off through DRC 03. First, it should form a part of your part 2 or part 5. The answer is part 2 because it is a liability paid through annual returns through a DRC 03. So the tax payable, the second column here, would become 12.5 lakhs. Paid through cash and paid through credit is a non-editable one. So it will remain to be a totality of 12 lakhs. So total tax paid will be 12, tax payable is 12 and a half. So there is a difference of zero point 0.5, 50,000 rupees, a difference which is going to be triggered. Whether is this okay? The answer is yes. Whether your working paper need to consider it is paid through DRC, the answer is also yes. There is one more place to ensure disclosure of your DRC 03, that is in your 9C. I'll come when I come to that. I'll also explain you that. So understand if there is any payment which is paid within the year DRC 03 or paid in the end of the year through DRC 03. Still, it should form a part of your tax payable. Your paid could be less and explain it through a difference. This is the way forward. Next important change is within the year, if any of your net ITC in your 3B has a negative amount. Say for example, in September 24, the net ITC in your GST 3B became a negative 15 lakhs rupees. It could have been paid from a opening electronic credit ledger also. Still, if a 3B goes negative, paid through ITC, triggering point in your GSTR 9 will add up that. Say we had an output tax liability paid through ITC of 7 lakhs and a net ITC reversal of 15 lakhs. Your paid through ITC, this particular table, it will indicate 7 plus 15. It will indicate 22 lakhs. What do we do at that particular time? My view, it is also paid off to government, right? Whether it is a part of your table for, no, but it was paid off, so it is a part of your tax payable itself. Add back in tax payable is one solution, so there is no difference at all created in this particular table. Second, leave the difference, explain it through a working paper. But if any amount is coming in the last table, which is your ninth table of your GSTR 9, that difference, then you should have clear working paper. Why is the difference? Paid through RCM, excess net ITC, whatever is the reason, please have it in working paper. Next is few important, another table of this is interest late fee penalty. So there's interest late fee penalty. This has to be hand punched. This does not have any source table above. In any of the tables above, we do not have interest late fee penalty payable. So the payable has to be hand punched based on the review and analysis. Say in 3B there is an interest payment of 1 lakh rupees which is paid off through 3B. It will definitely come in your paid through cash, interest paid through cash. This will be 1 lakh and it's a freezed non-editable table. But in your 9, you understood it was only 80,000 payable. Then definitely you need to understand to put here only 80,000, and in your annual audit you are confirming that there was an excess interest payment done. Vice versa. If the interest payment was 1,20,000 but only paid 1 lakh, then please put 1,20,000 and whatever is the difference, then have it, the difference would get triggered and you would have it as paid through DRC 03. So this particular table is important, and a thorough analysis of it as to when it was paid, how it was paid, and any differences needs to be captured in the working paper. Right? Okay. Give me one more minute. There's one more important table we all need to understand and consider. The HSN for the output tax. Till now, we have disclosed to the government the rate of tax, the category of taxes, the type of tax, CGST, SGST, B2B, B2C amendment, all these things we have disclosed. Now we are disclosing one more important aspect as to HSN level outward supply. While your table 18 is optional, the inward HSN, the table 17 outward HSN is a compulsory table. Few things to take care at this table. This table, whatever you form, should be equal to your 5n plus 12 plus plus 10 plus 11. That means your entire turnover, whether it is liable to tax, whether it is exempt to tax, whatever it is a part of your 5n, right? Outward 4 is your taxable turnover, 5 is your non-taxable turnover, putting together is your 5n. Similarly, a present year liability which is paid off in the next year or reduced in the next year is 10 and 11. Total of this has to be categorized in your HSN table. Okay, so when we look at the rate of tax, few more important aspects to be considered. This particular table has a inbuilt limitation, I would tell. It does not take any it back calculates, I would tell. Say if the rate, say if I'm putting 18,000 in 18%, then the taxable value has to be 1 lakh. If I put 99,000, it is not going to take. So there has to be a back calculation checkpoint from your taxes into 100 by your divided by your rate of tax has to be your total turnover. I hope it's clear. It has to be back calculated, put a checkpoint, or else your form is going to throw an error. Because of all these decimals, we could end up saying that my 5n plus 4, 10 and 11, say it could be say 80 crores, but your HSN table could be 80 crores 670 rupees. There could be a round of difference. That is okay. But have in your working paper the turnover category as a calculation on the rate of tax. So taxes into 100 by whatever is the rate has to be your taxable turnover here. If there is no back calculation, this table is not going to get filled up. The form is not going to accept it. Whether I should ignore my advances? Yes. Whether I can ignore my no supply transaction? If you know the HSN, put it. If you do not know the HSN, then you can ignore it. So this particular table 17 should be broadly your entire revenue a part of your 9, excluding of course advances and no supply transaction if you do not know your HSN over SAC code over there. HSN definitely at the 8-digit, SAC definitely at the 6-digit. If the category of your service provider which is in such a case which allows a lesser HSN, then it is okay. Otherwise, please put the entire HSN properly. I think we've covered or considered the entire output tax liability. Now we would go into few important aspect of your reverse charge before we go into your ITC. We'll just check back if any questions anybody could want to understand from the output tax. Then let's take one more call of it, or we'll go to the reverse charge. Okay. Reverse charge, firstly, is coming in your table 4G. It says inward supplies on which taxes are to be paid under reverse charge. So this is not your outward revenue, but an inward expense on which a tax is payable under the reverse charge. So that's going to come in your 4G. Similarly, or at the same time, it has multiplication effects. If we look at the table 6, of course, this table 6 is one other creativity in itself. It has numerous changes, but it has two categories: inward liable to reverse charge from an unregistered person, inward liable to reverse charge from a registered person, and import of services. These are the three categories totaling to which we could have paid taxes in the 4G of the table 4. Now, do I need to match this? First answer is yes. Your output tax liability, sorry, inward RCM liability has to be equal to or less than the credit which is availed. Less than in what scenario? Only one scenario. If there was an ineligibility credit and that was netted off, only then this answer will be there. So your inward RCM liability has to be equal to or less than the ITC which is claimed in your table 6. This is the first checkpoint everybody should have it. Next few questions. A tax liable under reverse charge of 23-24, a tax which is liable to reverse charge of the year 23-24 was paid in 24-25. Should it form a part of your 4G? Answer is yes, it should form a part of your 4G because the inward tax liability under reverse charge was paid in 24-25. Similarly, when we come to table 6, we have few categories of reverse charge item. We'll just touch base on that and then come back to ITC. Okay, three categories of reverse charge. One is reverse charge from a registered dealer, reverse charge from an unregistered dealer, reverse charge from an import of services. The two categories, reverse charge from URD and RD, the 6B and 6C, if you could see these two tables can be merged together. It can be either or. You don't have, sorry, C and D. My fault, I got D. The C and D. Inward liable to this. This can be merged together. That's still okay. You don't have to split it. But if you have the splitting, better do it. That's the view of it. However, IMPS should definitely not come under these two categories, and it has a special category. You need to mention it as import of services separately. Okay, when I come back to the reverse charge, few important questions we'll take. This question we've already answered. Outward supply of 23-24 disclosed in 3B of 24-25, whether it should form a part of your present year 9? Yes. And if you're taking, no, it was already part of 13 of the last year, then there will be a deviation, then provide reasons. This view also is okay. Only if it is a part of your last year table 13. Credit note raised, we already taken. Liability, we already taken. Yeah. So in this outward HSN table, should it also include inward reverse charge? Answer is no. Though it will form a part of your table 4, it is an exception item because it is an inward tax. So it should not form a part of your table 17. I think we've completed all the revenue and the reverse charge liability items. I think if we want to understand the forms, we better complete the 9C outward and then come to the inward from again 9 to 9C. It could give a better explanation. I would directly go to form, give few important elements so that we quickly come out of this and go to the table 6 of GSTR 9. Okay, when we look at the reconciliation table, what is changed in 9C? This is the 9C reconciliation table, right? Anything which is changed? The answer is no, nothing changed in this particular table. But the instruction of this is very clear. It says earlier there was an option which was given, anything which is unreconciled, You don't have to again categorize into unbilled advances, unbilled revenue, unadjusted. You don't have to categorize all these things. But now this categorization is a compulsory one. So you cannot take the shelter of 5O, which is unadjusted turnover for everything. So in the beginning of the session, we started understanding our revenue from the books of accounts. So whatever is the revenue, operating revenue, miscellaneous income, whatever is your revenue has to form a part of your 5A. That should be your starting point. You cannot under uh, show the same. Of course, whatever we spoke in our annual returns, which is our GSTR 9, will come auto-populated as a turnover declared in 9. What all this will consider? This will consider 5n plus 10 minus 11. So the entire outward turnover is going to come over here. So whatever is your starting point, your books of accounts, whatever is your ending points, your annual returns, a reconciliation of the same is what is expected over here. Few important tables will go by it. Unbilled revenue. We see this 5B, unbilled revenue at the beginning of the financial year. So if there's an unbilled revenue on which there is an output tax which is paid off, then please make it a form of this as an addition. Fair enough. So if there is an unbilled revenue on which there is no taxes and there is no revenue, then it will not even form a part of your table 9. Similarly, unadjusted advances, your closing. In 9, in table 4, we saw an example where we show advances unadjusted has to be there. Why? Because there is a tax which is paid off in GSTR 3B. It should form a part of your 9. But it is not a part of your revenue, right? So you need to add back the same to your revenue called as an unadjusted advance in the closing, which is a part of this particular thing. Unadjusted advance at the end of the financial year. Give me a minute.
New launch in postcode.
Yeah. Then there is a deemed supply under Schedule 1. Now, what is this deemed supply under Schedule 1? If there is a multi-locational client and there is a stock transfer, or if there is a cross charge, then definitely from one state to another state there could be billing, there could be taxes paid, etc. But the state in which there is a revenue in 3B, the same state will not have a revenue in your financial statements. Why? Because it is a inter GST billing. I mean, within the same PAN number, if there's multiple GSTNs, the same billing is being done. Whether it's a deemed supply, whether there is a consideration, whether there is no consideration but still a deemed supply, whatever is the reasons, if this is a category of the deemed supply, then put it under this set 5D. Similarly, if there is going to be any recoveries on which there is a taxes which is taken as a stand to be paid, it will not form a part of your revenue then, but still a deemed supply, you can put it under this. Next is credit note issued, which are your financial credit notes which are or which is issued but after your time limit, then you would have considered in your returns as no GST benefit to be taken. So these will form a part of your.
Ma'am,
Hello.
sorry to interrupt you. Slides are not visible, actually.
Oh, really? Okay, no problem. I'll just reshare.
Yes.
Is it visible now?
Yes, ma'am. It is.
Thank you. Okay. So when we were talking about the credit notes, then there are certain discounts, which is post supply discounts. Definitely, it will be reduced from our turnover. But for the purpose of GST, it is not reduced. So there's an add back which is required in this particular portion. Next is turnover for this period. This is redundant, but still forming a part of the table. You don't have to fill up anything. Next is adjustment on account of supply of the goods by SEZ to DTA. So any SEZ does not pay the taxes through its DSTR 3B, but from the customs portal. So there is a turnover on which there is a tax, but paid off not from GST portal, from the customs portal, then it will form a part of your 5K. So this is only if your client is an SCZ supply, not as a recipient, but itself is an SCZ. Only then it comes under this category. Next is 5M, adjustment in turnover for section 15. There are certain situations in which you are triggering your section 15. Classic example is your land deduction if your client is a real estate person. You take a revenue in your books, could be a unit sold, say, of 1 crore. The law is allowing you a 1/3 deduction of your land on which you don't have to pay taxes. That is triggered because of your section 15. So that 1/3 portion will come over here. So you will start from 1 crore, but you will put 33 lakhs as a 1/3 deduction here, and on 66 lakhs you pay taxes in your GSTR 3B. So this is the ideal disclosure of your turnover adjustment under section 15. Then of course foreign currency fluctuations, these are transactions in money, you don't have to pay any GST on it, but a part of your turnover. So there is an elimination portion which is provided here. So touch 5O only if there is no reasons which is provided above. And have clear working papers as to 5O, because of course in all the audits that is going to be one of the most important asked table of reconciliation. Okay, I think we've covered all these things. Then there's a second table, table 7 of your annual returns. This table is also, few things are coming from your GSTR 9, few things are coming from your turnover reconciliation above the table 5. So whatever is your adjusted turnover after all your 5O adjustments, 5M adjustments, whatever is the amount is going to get auto populated in this particular table. And then you need to reclassify out of that how much of it is my turnover on which there is no taxes to be paid. That is going to form part of your 7D, 7C and 7D. Of course, the same tables we saw in table 5 of your GSTR 9. Exempted, nil, non-GST, no supply turnover, zero rated, outward supplies on which tax is payable by your recipient. So the summation of 7B, C, D, generally a checkpoint should be equal to your table 5 of GSTR 9. So this checkpoint or the balance has to be done. Then whatever is the balance, of course, is the taxable turnover as your GSTR 9. Okay. Then one more important table, which is a rate-wise reconciliation. So by now we have given the government a HSN-wise reconciliation. This is a place where we are giving them a rate-wise reconciliation. You could see in every table there is something called as RC. That means a reverse charge. While we spoke about GSTR 9 table 4, we also spoke the reverse charge also should form a part of your table 4, because it is a inward but paid from the client side. So the entire output tax liability, entire inward liable to reverse charge rate wise has to be bifurcated and put in this particular table. You see there is a new category, supply on which e-commerce operator is required to pay tax. So we were speaking about a hotel or a restaurant services that will have to be put under 5K2. It's a separate category which is provided. So this is the rate of taxes and for the e-commerce operator which is specifically there. Next is interest late fee penalty. While we spoke about table 9 of GSTR 9, there also we spoke about interest late fee penalty. So anything which is payable and paid, or not payable but pending to be paid but shall be paid now, whatever is it, it is a interest late fee penalty has to be put over here. This is not auto populated, has to be keyed in. Now this particular table in entirety compares whatever is the rate wise, either outward taxes or the inward RCM, minus the tax payable which was disclosed in a annual return. Now it takes comparisons at CGST, SGST, IGST only from tax amounts of your GSTR 9. So your interest, late fee and penalty, unfortunately, this auto-populated figure at 9Q does not consider the same. So any interest, late fee, penalty will always be under unreconciled payment, and you need to explain that it was paid through 3B or it was paid through DRC, but this particular table does not auto-populate or auto-capture the same. So interest, late fee, penalty, always an unreconciled table for this particular place. Further, if any taxes are paid through DRC 03, the this particular table below it, there is reasons which you can mention. So I would suggest mention the DRC 03 number, date, when it was paid, on what it was paid. This is the category which is in the table. Say 5% tax liability, scrap sale was paid off to DRC 03. So mention the rate and also the amount and the DRC 03 details over there. Right. I think with this we've completed the entire anatomy of the revenue side. Now, four more important portion is your ITC side. Yeah. Any questions on the entire 9C for the outward? We could take it, or then we go to the inward ITC. Okay, the most spoken about topic for the last 15-20 days for every professional or every team member I meet is this particular table called as table 6 of GSTR 9. Why is it important? The table underwent now GST. I would tell the form is in 3.0, not even in 2.0. The last Friday had one more FAQ on it. So there's an instruction change. There was an FAQ which was issued. There is a additional FAQ also which is issued. So there are three important changes which came to table 6, which is impacted table 6. Important. While we look at the particular reconciliation, we saw outward is broadly a balance between books and your returns. Your table 6 is a balance between your books, invoice date, your 2B period, 3B disclosure, and the category of taxes. So it has got a various combination of it, and let's look one by one. Table 6A is an auto-populated amount. What does it capture? It captures all data of 4A of GSTR 3B. 4A of GSTR 3B has IMPG, IMPS, all other ITC and reverse charge. All four category put together at a gross ITC. Whatever is your gross ITC will come and sit in your 6A. This is an auto-populated amount, no addition, deletions or editing which is possible. Next, first new table which is come is your 6A1. ITC of preceding financial year availed in the financial year has to be put over here other than 180 days. So there are two category of ITC of 23-24 which can be taken in 24-25. One, an invoice of 23-24 which is availed in 24-25. This particular one, invoice of 23-24 which is availed in 24-25 has to be put in your 6A1. There is a second category, 180 days reversal, a vendor non-payment because within 180 days a vendor was not paid, was reversed in 23-24 but re-availed in 24-25. Should not be put in 6A1, and there is a specific place called as 6H which is provided for the same. Okay, I'm reiterating. 6A1 is for any invoice which is dated 23-24, which is claimed in the financial year of 24-25. Now, next question. Whether 6A1 should consider IMPG, IMPS, RCM or all other ITC of 23-24. My view, it should consider two categories. Only IMPG and all other ITC. RCM and IMPS, it should not be forming a part of 6A1 because the liability itself was paid in 24-25. It should form a part of your bottom, that is 6B and ahead. It should not form a part of your 6A1. The instructions says I invoice dated 23/24. So there's an interpretation which is possible to capture the particular table of 6A1 with all things. That is IMPS, RCM, all category also. So there's an interpretation which is open there. In my view, only IMPG and ITC should, all other ITC should form a part, which is an invoice dated 23/24, which is availed in 24/25, should form a part of the 6A1. That's all. Say there is an ITC in your GSTR 3B at a gross level, say 10 crores, out of which a invoice which is dated 23/24 say is 1 crore. So your 6A2 is going to become 9 crores. Out of this 9 crore, we need to break up into various multiple parameters ahead. Okay. First, let's break up simple things. Say my inward liable to RCM for say 1 more crore. So in my 6C and 6D, whatever is the category, I put 1 more crore. Out of 8 crores, 1 more crore is gone. So I have another 7 crores with me. Say my import of goods category, whatever is there, say it is another 2 crores. So what I'm left with is 5 crores. Out of this 5 crore, say my import of services is 1 more crore. Okay. So eliminate that. What I'm left is 4 crores. Now this 4 crore should be studied in depth. This 4 crore is the gross all other ITC availed in your GSTR 3B. Gross all other ITC availed in your GSTR 3B. This could form two particular elements. One is availed permanently within the year, availed temporarily within the year. Repeating again. Availed permanently within the year or availed temporarily within the year. Because of the circular 170, I'm sure multiple people would have done this analysis within the financial year, which is could be availed, reversed, and re-availed also. So I have 4 crores with me and I need to divide it into categories. Let's see what this 4 crore belong to. So out of this 4 crore, let me just take a 10 lakhs as an example. This 10 lakhs was temporarily availed reversed in the month of April. In May, it was re-availed. This 10 lakhs was temporarily availed reversed in the month of April and it was re-availed in the month of May. April was the first availment. The 10 lakhs will go into 4B. May there was a reversal. It will go to my 7E, which is a reversal. So April itself there was a reversal. It will go in my 7E. So if I look at annual returns for April in isolation, one item of 10 lakhs is going in 6B. The same item of 10 lakhs is going in my 7H. So there is a 0 ITC which is taken in DSTR 3B. Now let me add May. May had ITC of 10 lakhs which is re-availed and it is permanently availed. This will form a part of 6H. So any ITC out of this 4 crore, what you need to understand whether it is a first availment or a second availment. If it is a first availment, it will form a part of your 6B. This first availment, if there is a reversal, it will form a part of your 7H. And if it is a re-availment, sorry, 7E, and if it is a re-availment, it will form a part of your 6H. Let me just see if I've got a form for me to just put it up for you. My screen is visible, right? I have a PDF which is open. Not sure if it is visible.
It is visible, ma'am.
It is visible. Okay, thanks. So this is the table which is there, which is GSTR 9 table. Okay. So anything which is first availed is going into your 6B. Anything which is first availed but reversed temporarily is going to go and sit in my reversal of GSTR 9, which is other reversals. It's not appearing. Other reversal, which is specifically, please specify. So you can put it as a temporarily reversal. The third time you're actually re-availing it permanently, then you put it in this particular category. Amount of ITC reclaimed under the provisions of this act. Okay, so it's important to understand the availment, reversal, and permanently re-availed in which category you are going to put. Now, the second category, there are few line items of 24-25. Say in the month of March, out of this 4 crores, again we come back to the same. Out of this 4 crores, let me take a 50 lakhs line item. A 50 lakhs line item was availed in the month of March because it was a part of March to be, but it was temporarily reversed in the March month because the goods were not yet received or the items was not yet accounted in the month of March. This is March 25. In April 25, I re-availed. Where will this go? This will form a part of your 6B. Reversal will go a part of your 7. Re-availment will go a part of your table 13. Table 13 of your GSTR 9 is also made compulsory now. ITC of 24-25, which is availed in 25-26, has a table called as 13, and the 13 table is very much compulsory right now. So anything which is availed, reversed, reclaimed in the next financial year shall be there in 6B, eliminated in 6C. So your 7J shall become 0, but form a part of your table 13. So it is this year ITC which is availed in next year. So these disclosure for the present year is very, very important from department and for review aspect. This is purely as per FAQ also. Okay. Next few checkpoints. We saw the reverse charge item has to be, the PPT is visible, right? Because I'm back to PPT. Again, I don't want not to be visible. Hello?
Huh.
Okay, done. Thanks. Okay, so table 6E and D had two categories. One is reverse charge under URD party, reverse charge from a RD party. So if we are classifying these two categories separately, then whatever is a reverse charge from the registered party, have a cross check of the same from your GSTR to B. Your to be triggered, whatever is your reverse charge, if it is higher or lower, will be definitely analysis of your department review or department scrutiny. So please review it now only. If there is any deviation, put it on record. If there is a payment, then please make the payment clearly and to ensure at least within the time limit. Abhi to time limit is also gone, but at least put it on record as to why there was a deviation, and if there is any deviation, correction from the vendor aspect, anything has to be put on record. Next is import of goods. Import of goods will also have two categories. Import of goods, which is a bill of entry which is dated 23-24. My view, it should form a part of your 6A1. If it is a bill of entry which is dated 24-25, then it should form a part of your 6E, which is import of goods. This bifurcation is important. I'll tell you when I come to table 8. Why? Then import of services. Cross check your foreign currency transactions, whether for any foreign currency transaction which is for your goods, then eliminate the same. Any foreign currency transaction for import of services, then have these two checkpoints. Whether it is an import of services which has a place of supply in India, or whether it is a import of whether it's a foreign currency which is a service category which has a place of supply India or outside India. Anything which has got a place of supply in India, then you should understand the trigger point of your import of services is there, and whether there's a payment or not there. If there is an import of services, or if there is a reverse charge on which there was a tax liability but not paid within the financial year but paid in the next financial year, then do not add it up here. Whatever is paid within the financial year, only then show over here. Do not add it up here. Okay. There are few people who have followed ISD. If there is any ITC which is reversed in, which is received from ISD, then it should come in a part of your 6G. However, a cross check of the same to the GSTR 6 also needs to be done to ensure there is no excess availment, because this is your annual rectification time. 6H, I've already explained you. It is for your reclaimment ITC. This table has two portions. Anything which is re-availed for the second time, then will come over here 6H, other than 23-24. Anything which is re-availed for the second time other than 23-24 will come over here. Second is anything which is 180 days reversal, 3B non-filer, which was reversed in the last year but re-availed in this year, then it will form a part of your 6H. So your rule 37 and 37A, 180 days and 3B non-filer. If any ITC was reversed and reclaimed, then it will form a part of your 6H. Then of course the tran credit portion, if anything, any specific client of yours has it. Then the last one, 6M. Up to last year, 6M had a very wide interpretation. It was a residual category kind of a thing. As of this year, it is very specific. It is no more a residual category. You can't dump everything in 6M. You have to identify 6M has only three portions. ITC 01, which is your stock for the first time ITC availment, ITC 02 on sale or merger, or the 2A, which is for your acquisition. So only three categories are there which can be in 6M, and it is no more a residual category. If we work in this mechanism, what we started, say a 10 crore ITC is now broken up into IMPS, IMPG, RCM. Within the year, availed, reversed, re-availed, all these categories are going to be classified. Once this classification is there, your 6J, which is the say 10 crore minus all these things, the difference has to be zero. So you've classified the entire 10 crores into various buckets. So your 6J has to be nil. That is the FAQ clarity also, which is come up. Okay. Then we have anything right. Okay. Then we go to the next table, which is table 7. This is how the table 7 appears. 37, any reversal which is done within the financial year, say in 24-25, you identified any vendor to whom you have not paid payment within 180 days and you need to reverse the ITC and reversed it in 3B, then you can put it over here. There are few situations where you identified, okay, I'll reverse it through DRC 03. Then also you can disclose it over here. Of course, there will be difference, but you will have working papers for it. 37A is for your 180 days. 37A is for your 3B non-filer. So 37A is also now active, introduced, effective. So if there is any vendor of yours who has not filed their GSTR 3B, then after 30th of November, you need to reverse the said ITC and reclaim it whenever he files their 3B. So 37A is for that. Then 38 is for banking and financial companies. 39 is for ISD reversal. 42 is your proportionate. Whenever there is a proportionate reversal of ITC, if there is a combination of a business, portion of the business income is taxable, portion is exempt. So if there is a table 5 nil or exempted of your GSTR 9, then invertedly you should understand there should be a portion in your table 7 unless and until there is an exception which is provided for the same. 43 is for a capital goods and proportion turnover which is exempt, and this. Of course, 17.5 is your ineligible. Okay, few questions over here. In 3B, your ineligibility was not at all disclosed. Whether we need to disclose over here? Answer is no, do not disclose. People have done showing it in 6 as availment of ITC in annual return and reversal in 17.5. They've got complete notices. If there is no gross ITC in your 3B, do not put it in your table 6. Similarly, if there is no 17.5 disclosed in your GSTR 7, do not disclose it over here. No, it is a complete mismatch. If I do not show it, it is going to be leading to any incorrectness. Show it, ensure to inform to the department and the GSTN through maybe a ticket or a grievance immediately. So this record is going to be helpful for you in your future notices. Then 7H. 7H can, 7H we already spoke, it is for your temporary reversal. Now, whether 7H and 6H has to be same is a question. My view, keep the temporary reversal in a separate column of table 7. All your temporary reversal let it be separate column. 7H now it can be plus 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 7H1, 7H2, it can be added, multiple line items can be added. So my view, whatever is your temporary ITC reversal for the entire financial year, which is within the year which is reversed, either which is reclaimed within the year or not reclaimed, put it in 7H in a separate line item. This is going to be helpful for a longer period of time. Okay. Then we take another important table of reconciliation, which is your table 8. Few important aspects. Table 8A is non-editable. You cannot edit anything in table 8A. What appears in table 8A, that also is a different question. If you download table 8A from GST portal, that will have few elements, but the total of the same will not be equal to the user interface table 8A. So you see table 8A is just an amount. It's just an amount. This amount, how it is coming, how it is to be calculated is not provided. But the FAQ provides for some clarity. So let's understand. When you download the Excel 8A, what will be there, but what you need to eliminate. That's very important, right? So when you download the 8A from the GST portal or from any of the softwares what you have, that will have few things. Tax liable under reverse charge. This has to be eliminated because it will not auto-populated in your starting point of 8A. Any invoice which is dated 23-24, amended, edited, debit note, credit note, whatever, any invoice which is dated 23-24 should be eliminated. Even if it is a first time appearing in your 2B of 24-25, earlier it was not at all there. Still, any invoice which is there, eliminate it. Next, if there is an invoice, say a invoice of say 200 rupees was provided and then it was amended to 180, the 8A will take only 180. In your Excel, there will be two items, 200, 180 both. But whatever is amended, the new item, only then 8A will take. Okay. Change in GSTN. Earlier, a 200 rupee credit was passed on to my GSTN number. Now it is edited and passed on to ABC GSTN. That time, in my document in 8A, it will show as amended. Amount will be there of 200, but once it is amended to some other GSTN number, 8A will not agree it will eliminate it. So amendments, RCM, invoice dated 23-24. If you eliminate these three important categories, then your 8A Excel will have the same amount of your 8A UI, the user interface of your GSTR 2B. GSTR 9. So this analysis is very, very important to understand what is your starting point of your 8A reconciliation and where are you heading to. If you do not have an item-wise reconciliation as a starting point, then it's going to be too much confusing. So first you need to download the Excel, derive how the user interface amount is going to appear. Then you can do your reconciliation, right? In table 8A is going to be auto-populated from your table 6B. What was my 6B? 6B had all invoices, which is all other ITC, which is either availed for the first time in 24-25 with invoice dated 24-25. What does it mean? If you are following circular 170, my 8A and 8B should be same. Ideally should be same. I'll tell you few exceptions. So if I'm following circular 170 in my 3B and my disclosure in table 6B is proper and I analyze my user interface of 8A properly, my 6A and 6B should be same. Then what will come in 8C? Any invoices which is dated 24-25, any invoice, credit note, debit note which is dated 24-25 but appearing in my 2B of 25-26, would you have taken actions in your 3B of 24-25? No, of course no. It was not at all there in my 2B. Even if it is there in my books, I would have not taken the credit if I'm following circulars 170. But your 8A increases the ITC or decreases the ITC of invoice or credit note dated 24-25 which is uploaded by the vendor in 25-26. Say within the year I had 10 crore credit, 10 crore in 2B, 8A, 8B is 10 crore, 10 crore, 8C is 0, 8D difference becomes 0. We are all happy. But there are one vendor who's uploaded a 50 lakh rupees of ITC of invoice dated 24-25 in 25-26. Your 8A will become 10.5 crores. 8B will become 10 crores. Your 8C should be that 50 lakhs. So you need to identify those invoices which are uploaded by your vendor in 25-26 or credit note in 25-26 with the invoice dated or credit note dated 24-25. Only this should ideally be forming a part of your 8C. Further, no, vendor is uploaded but I have not taken. Vendor is uploaded or the credit is not mine. Or vendor is uploaded but the same is not available or ineligible and I have not taken actions in my 3B. Then definitely the difference in 8D is going to appear and please mention ITC available and not availed in GSTR 8E. Say for example, in many of the companies or the corporates, civil or building, the entry is directly capitalized. Entry is directly capitalized. And also instructed that this particular vendor of ours is a capital goods service provider and it is capitalized to building account. Do not touch this credit in 3B. So people would have followed one circular 170. Exception could be these line items. So this never form a part of your gross ITC. So it should not form a part of your table 8 also. The amount should be unmatched and it should be lapsed or ineligible. So these are few categories of your 8E and 8F. I hope I'm clear to this. Next is one more table which is introduced, which is a new table again, which is 8H1. IGST credit of import of goods in the next financial year. That means any bill of entry which is dated 24-25 but availed in 25-26. I'll repeat again. Any bill of entry which is dated 24-25 but availed in 25-26 has to be part of your H1. We'll need to read 8G, 8H, 8H1 and 8I. These four categories together. 8G says IGST paid on import of goods. The department analysis or the review in future is going to be definitely 8G versus 2B. If 8G has import of goods, your 2B also has import of goods for the year. So your import of goods in your 2B say is like 80 lakhs rupees. But your actual import of goods in your books of accounts says 95 lakhs. That 15 lakhs did not come in your 2B, but it's a part of your bill of entry. Then actuals, whatever is your bill of entry on which you have paid the duty of IGST has to be form of parting of your 8G. Internally, what reconciliation you need to keep? 8G versus your 2B versus your ICE gate. So any import of goods which is there has to be put over here with the date of 24/25 only. Now the second table 8H has IGST credit availed on import of goods. As per 6E above. What was 6E? It said import of goods on which ITC is taken. Now when I spoke about 6A1, I did mention you, let us take a view import of goods with 23/24 also to put it in 6A1. This 8H was the reason for it, because 8H has to be import of goods within the financial year. If I do not eliminate import of goods of last year and this year in 6A1, your 6E is going to be a higher value. If 6E is a higher value, your 8G disclosure is going to become a wrong comparison. So in 6A1, that is why any invoice which is dated 23/24 has to be eliminated in 6A1 only and not forming a part of 6E. And the minute it is not forming a part of your 6E, 6E is going to be import of goods with the invoice dated 24/25 availed in GSTR 3B. 8G can 8H1 can become bill of entry of 24/25 availed in the next year of 25/26. Adding up together should become total of your bill of entry. And this whatever is your total of your bill of entry should have a comparison in your GSTR 2B and ICE gate. Difference of cost should be zero unless and until it is a wrong bill of entry which is passed on in your name, which is a very strange category as such. And if there is a difference which is going to be there, a triggering point in your table 8, look at table 8J. It says ITC available but not availed on import of goods, or total ITC to be lapsed in the current financial year. And in current financial year, whatever ITC we are lapsing, a part of it is 8J and 8J is coming from 8I, which is the difference. So be very careful. Do not lapse any ITC on import of goods because of there is a new table called as 8H1. Now, whenever there's an 8H1, that means you're indicating a part of ITC of this year which is availed next year. So any category in 8H1 should also form a part of your table 13. That means ITC of this year which is availed in the next financial year. I hope this entire reconciliation is clear, or I'm not sure if I've confused you more, but this is very relevant. And this is going to be network. Okay. Certain of the ITC, which is a single page, one pager reconciliation in your 9C. So entire 9 is a broad basis of your books 3B and 2B. 9C is broadly based on your books of accounts itself. So this table 12 of your GSTR 9C is the table for ITC reconciliation from your books of accounts to GSTR 3B. Let me explain you this and the importance of other tables to this. What is table 8A? Like we saw, table 5A is the turnover of the books of accounts. Table 12A is the ITC available in the books of accounts. If it's a multi-state, take your entire input tax ledgers, which is matched with your financial statements. Please bifurcate into state-wise as per books of accounts. Many times we're able to see, say, a credit of Maharashtra in the 3B which is booked in the books of accounts of Gujarat, we need to ensure your books place of business is also changed to that extent. So it becomes very most important to understand in books of accounts in which state the said ITC is shown as an asset.
Ma'am,
Either, yeah.
slides are not again visible. Could you please reshare?
Okay, okay. Visible now?
Yes, ma'am.
Thank you. Okay. So we were talking about the input ledgers. There could be a situation where your books of accounts, the place of supply is proper. Say there is a labor supply vendor. Labors are supplied in the state of Gujarat, but he's been billing continuously to the state of Maharashtra in your GSTR 3B, and the person who's filed the returns could be continuously availing the credit in Maharashtra. But if you look at the invoice, the place in which he is actually providing service is Gujarat. So shouldn't we take an amendment? Shouldn't we take rectification of actions? Of course, through whatever manner. The time limit now could be lapsed, but you should at least understand why there is a change of business supply, place of business, either in the books of accounts or in your 3B. Either one of it is right. Both cannot be right. So in your 12B, your starting point should be your books of accounts. Take the entire input ledger, get the business place mapped to the same. Eliminate utilization entries, eliminate availment entries, eliminate ineligible ITC transfer entries. Say in my books of accounts, a closing balance of my trial balance in the input ledger, say is 1 crore. It could be a debit balance. Then if I eliminate the entire ITC utilization for the entire year, say I eliminated 10 lakhs, 10 crores. So the ITC for the financial year is 11 crores because utilization entries are credit balances. Say I start a starting point of 11 crores. Now this 11 crores is again then bifurcated into my state wise. This state wise, whatever is the amount we're going to get, put it in your table 12A. Next is 12B. ITC booked in the earlier financial year, claimed in the current financial year. It should be broadly matched to the 12C of the last financial year, right? See, what is 12C? ITC of the current financial year to be claimed in the next financial year. So your 12B of this year should be broadly coming from your 12C of the last financial year. If it is not filled up or uh, any stand is taken not to give a breakup, then please at least have a backup working as to okay, 12B is equal to 12C of last year. It can be lesser for various reasons. I would explain you the same, but it cannot be higher if the amount is already punched. Say last year in my books of accounts, in 12C, we had put an amount of 10 lakhs, which is to be availed in the next financial year. But while reviewing the 10 lakhs in the next financial year 3B, you found out, okay, out of 10 lakhs, I'll put in 3B 10 lakhs, but I will avail in net ITC only 9 lakhs. Why? 1 lakh was ineligible credit. But I found out while doing the 3B. So your 12C of last year can be 10 lakhs, but your 12B of this year has to be only 9 lakhs because the comparable in which you are going to do ITC claimed in your annual return is 7J. That means it's a net ITC comparison and not a gross ITC comparison. So your 12B can be lesser but cannot be more than 12C of last year. Is there any scenario where it can be higher? Say your 12B itself went negative in the last year for whatever reasons. Then your 12B, 12C can have any differences. Yes, of course, with the working in proper place. Next, ITC booked in the current financial year to be claimed in the next financial year. Say I started my books of accounts say of 11 crores. I added last year table 12C this year a 10 lakhs. I have 11 crore 10 lakhs ITC to be availed in 3B. But in 3B, I have availed say only 10 crores. So I have a difference of 1 crore, 1 lakh, which is pending to be availed. It should form a part of your 12C. So we started with our books of accounts. We added the last year ITC. We'll eliminated this year ITC availed in the next year, and we should be come back and answer that this is the amount which is availed in GSTR 3B. But we have one catch this year. You remember we entered one amount in 6A1, which is ITC of 23-24 availed in 24-25. Because we eliminated in 6A1, 7J has also eliminated that amount. So any ITC with this invoice dated 23-24 is not forming a part of your 7J. The FAQ, if this is because of the FAQ itself. Because it does not form a part of your 7J, ITC claimed in GSTR 3B will be lesser than your 3B. Say in your 3B you have availed an ITC of 10 crores, but out of which 23 in 24 invoice dated is say 50 lakhs. Your GSTR 9 auto populated figure to 9C will have 9.5 only. It will have 9.5 only. Because it has 9.5 and in your books it have 11.1, there is a difference of 1 at 50 lakhs because of the 6A elimination and 1 crore 1 which is your 12C item. I hope my numbers are also clear and we are able to relate to. Understood? So this year you will have one unreconciled item permanently considering the FAQ that will be equal to your 6A1. Now, Friday there was one more FAQ which was released as an additional FAQ. What it said, okay, if this difference should not be there, then 12B also you eliminate. No. What is 12B? 12B is also invoice dated 23-24, which is availed in 24-25. Eliminate 12B also. You are already eliminated the invoice level in 6A1 of your GSTR 9. In 12B also you eliminate. So both elimination are gone. Your table 12 will be purely ITC for the year, and tables 7 in your GSTR 9 is also for the financial year. There will be comparables, easy comparables. But the same FAQ also gave clarity. If somebody has a posting dated reconciliation, that means invoice of 23-24 which is posted in 24-25, very well possible, right? February, March, these 2 months, many invoices are there in the GSTR 2B, but which is received by the finance team only in the April, May, June. It could so happen that the invoice of 23-24 is posted itself in 24-25. Then this amount will form a part of your table 12A. But it will not form a part of your 9 because invoice dated 23-24 is eliminated. So then you will still have that as a difference as an unreconciled item, and please provide explanation to the same is what the FAQ is providing. So I'll just repeat two scenarios. One is invoice dated 23-24 which is posted in 23-24 will be a part of my table 12B. FAQ is suggesting eliminate the same, do not mention the same, because GSTR 9 is also eliminated the same, and 6A1. Second scenario, invoice dated 23-24 which is accounted for 24-25. Then this will form a part of your 6A1, but these invoices are eliminated in 6A1 of your 9C. There will be an unreconciled difference. Please explain the same. So this is how the form is being derived and formulated. I think I've covered this particular reconciliation also. Let me see table 14 of your GSTR 9C, which is your uh, uh, expenditure head-wise is an optional table. It's not required to be mentioned. If anybody wants to use this and mention, they can use that clause 44 of your 3CD as a working base. But this is a complete optional table. I will just verify if we missed anything. I do not think so. Okay. I think the broad form explanation of all tables is now completed. We will continue, or rather the last part of the today's session, as to few important aspects which is other than numbers to be technically verified in the course of your annual audit. Few things on the supply, few things on the procurement. Disclosure we've already discussed. Updates also we've already discussed. We will go into few important aspects then. Okay. While we're reviewing the outward supply, while we spoke about many of the numbers, whether it is matching with your financial, whether it is matching with your 1 3B, it could be many things. But on a technical aspect, please ensure to review what is the notification through which the exemption was given, whether the exemption notification is relevant for the financial year of 24-25, whether it's a conditional exemption, whether the client in all formulation fulfills the conditions in all aspect. This is very, very important thing. There are few places where there is rate concessions which are provided. Say for works contract up to last year, if the earthwork is say more than 75%, then the view of 5% rate of tax could be given. Then whether at all the condition which is there is completely fulfilled, which is important to understand, to adopt a rate of 5% where the entire services is under 18%. Say WTG also has a rate change in the last year. It had earlier 18, then 12, and this year it is 5. So in various years, there is various rates which are changed. So in which year, which month the transaction belongs to, and in that particular month, what was the rate of tax has to be examined properly. Next, related party transaction. While we saw the Schedule 1 deemed supply transaction has one particular place as a disclosure, also, very much ensure that valuation aspects are completely covered. Now, what is this valuation aspect? Whether there is an open market valuation, whether the value is at least cost plus 10%, whether there is in kind, has to be reviewed thoroughly. These are not numbers. These are not numbers. Few things where there is goods, this can be in numbers. These are absolutely not only numbers but beyond numbers. So visit to your client place, understand. Okay, give you one example. When last time for one client place when I visited, then I understood there's a lot of branding which is given from an outside India party, which is fully stickered, categorized, full branding, hoardings, everything is put up. And when I check their ledger, not a single charges were put on the said company. Then we understood, okay, there is a branding which is provided, but there is no charges charged by the outside India party, but it is a related party transaction. And because of which there has to be a valuation without consideration, and there has to be a reverse charge which is going to be triggered for the same. Similarly, at various warehouses, at various gate registers, you could find out there are stock registers. In the stock register, you could find in and out to understand, okay, from any related party, is there any in or out transaction, to understand if there is any liability which is not paid off. Of course, last year ISD or cross charge, both the things were there. Cross charge was not mandatory up to last year. ISD was not mandatory. So at least if cross charge is done, then what is the valuation methodology adopted there? What are those expenses which are forming a part of the cross charge? Whether anything more has to be there or not is also a checkpoint to be considered. Next is related persons. How do you identify whether somebody is related or distinct? One, definitely distinct is a little easier to identification. Related party, please look at the MCA website. Please look at other disclosures which are there. A TP report, transfer pricing report, is a wonderful report to understand who are those related party, what valuation mechanisms are also treated. So other reports or other category of report is very important to understand who are your related parties. And if yes, then the valuation. Right? Then the composite, mixed or non-composite supply. So while we do our classification of rate of tax, That's what I told you. Generally, we look at the HSN or the SAC and then we do the rate of tax. We do not do much about why at all it is a goods or a service or whether it was a composite or mixed. So understand that also. Say there is a repair and machinery installation services which is provided. All through the year, anytime there is a repair, it is continuously provided. Along with the same, there is also certain goods which are also supplied, and the goods value could be higher or lower, whatever it is. But if the principal supply itself was of repair and maintenance, along with it there was certain goods which are provided, whether it is a composite, whether it is mixed, whether the rate of tax has to be changed, is a review point or a checkpoint which is required to be done. Advance receipts, whether the advances which are there at least as on 31st March, forget about everything else. Advance receipts at least as on 31st March, whether they are received for goods, whether they are received for services. If services, then whether it is extra received or whether it is received for one particular service which is pending to be supplied, from how much period it is outstanding to be supplied, is one other category to be understood. While we understand an advance, we also need to understand whether an invoice raising itself is being delayed. Say recently there was a huge advance which was there. In the course of review, I understood an expenditure also is there, advance also is there. Why billing is not raised? Then the internal team had to realize and understand, okay, the billing had to be done within the financial year. So they had not yet filed their statutory financials or anything. So they ensured they billed, knocked off the advance, and then had a huge GST implication. So whenever there's an advance receipt, also understand whether the invoice itself was delayed to be raised. Right? How do you understand that? Equal expenditure. If expenditure is also incurred, advance is also received, whether the milestone for the providing services is not completed. In my view, most of it is completed, unless and until it's an exception category. Next is export conditions and documentations. We spoke about SEZ authorizations, export documentation in term of having the all the shipping bills with us, understand whether the goods are actually physically moved. These are few important documentation. While I speak about the export condition, I would also like to speak about the merchant exports. Merchant export is a very weird category where the government is given 0.1% as a rate of tax. Remember, it comes with conditions. It comes with a whole set of, I think, 8 to 10 conditions are there. If any one of the condition also is not met, and one of the important condition is the ultimate export has to happen within 90 days of the goods removed from your factory to the merchant exporter. So have these checkpoints and documents very much in hand. If it is not exported, say the actual export went on 101st day, then the entire rate benefit of 0.1% is gone, and 17.99% is the differential rate of tax needs to be paid off. Right? Then classification rate of tax, we've spoken enough. The HSN, the classification, the time in which the goods were provided is very important. While we look at the entire P&L, few items of balance sheets are also very important for the outward supply determination. One of it is a fixed asset. Fixed asset has addition, deletion, reclassification, and depreciation. Whenever there is a removal of a fixed asset, understand there is an impact of GST in three terminologies. One is whether the fixed assets which are removed had tax or did not have tax is one first important. Okay, it had tax, then valuation is a second aspect. Whether the value was equal to or more than the valuation principles of GST is another important thing. If no, then the differential also has to be additionally paid off. Next is motor vehicle. Motor vehicle itself has a different methodology of calculation GST. Whether the motor vehicle was sold at a profit loss, if it is a profit, only on the profit there is a GST element on the same. Whether I can sell my motor vehicle at a profit and pay taxes on the full value, up to you. If you collected, pay, no problem. But It cannot be lesser than the profit element. Then sample removals. This is something which is clearly like unless and until you have a thorough review of your stock transfers or a stock removals or an inventory, then this is very difficult to identify. Then scheme of supplies, what we supply scheme is the discount mechanism with customer, which discount and when it was provided, whether it is pre-agreed. Ensure to have that document hard copy or a soft copy in your audit folder very clearly. Sale on approval basis, say the 6 months period which is there on sale or approval basis. This is also very important. How do you understand this? Through e-way bill analysis. If there is something sent on sale on approval or an inventory ledger also. If something is removed on an approval basis but not returned or no approval is received up to 6 months, then it is a deemed supply or deemed sale for the purpose of GST. Then also test the time of supply concept becomes very tricky in services. How do you understand whether your services was completed in the same month in which you have raised your invoice? Understand your milestones, understand the agreements. If the invoice is delay raised, then the interest implications pre-intimate your client. Okay. Few things on your procurements which are very important aspects. I think we've covered everything here. Okay. One is claim of ITC. Whenever an ITC is claimed, definitely we've all understood that invoice should be there. It should be there in my 2B. The goods should be received. The services should be received. All this multiplication. Okay. Whether the screen is off again? Hello? Hello?
Yes, ma'am. Now it is okay.
It is okay, right? Okay.
Yes.
Uh, okay.
The
Then
PPT is not
importantly,
visible.
in our 99C, there is a classification of input and capital goods which is required. So this classification of whenever you're doing a table 6 input and capital goods. Remember, input service category is not a compulsory table, but capital goods is a compulsory table. So if there is a capital goods bifurcation of an ITC which is provided, ensure the same is not a civil or the same is not anything which is immobile property other than plant and machinery. If it is, then ensure to indicate there is a exposure which is going to be there for future assessments. Then, if there is any job work also forming a part of the ITC procurement, that means, of course, one is on the compliance, which is your ITC 04. Second is also to understand how much of the job work goods which is went out did not come back, whether it is an input or a capital goods, depending on 1 year, 3 years, whether any inputs are moved to your job workplace and the same is not received back. There are certain expenses you could also see. Job work stock verification could have happened. You could have debited your stock job worker for the loss of inventory. These are few indications to understand. Okay, a liability also needs to be paid on the same, not only taking a stock reduction. I think we've covered all this disclosures while we spoke about the form itself. IMS impact also we've already spoken. Okay, certain do's and don'ts, which is very important or a key elements to ensure you keep in mind before you file your 99C is keep backup of every line item, whatever you do it. Do not punch figures in your 99C. There should be some automation at line level which is appearing in the front page of your 99C. If you do not, then tomorrow your analysis or review with officials is going to be at invoice level and you will be at a big trouble. As a student, uh, I would suggest you to have automations with the use of Excel, with the use of AI, and perform your reconciliations in a more effective manner and have a base. Do not go on doing reconciliation. Have a base. What is my starting point? What is my ending point? What are the various differentiation? Have this thought process when you're doing the reconciliation. This will give you clarity as to why you're doing what you're doing and not only doing it. uh, Table 8 I've already explained you, very very important to understand what is the amount which is coming in the user interface, or else it's going to be difficult. Any spillover transaction last year, this year, next year has to be documented very well. One more important, if there is multiple location clients, if there is a nil return at any place, do not miss to file it. This is the feedback from my team. They generally are gone into the last day. So do not ignore the same thing, which is nil return of a multiple location. If there is a maker of the entire 99C, my reviewer can become my article. It is not a problem. But if I am making it, there has to be a checker and there cannot be a same person. Ensure if there is a maker, there is a checker and there is a different person aspect to the same. I think with this we've completed the session in whole. Any questions, anything, I would be open to take it. Yeah, any questions anybody has? I've stopped sharing my screen. Yeah, the PPT will be shared to ICI and it will come to you. All right, then I think we've closed the session early. Happy Sunday to all of you. Thank you for joining me on a Sunday morning. Thank you, everybody, especially ICA Vikasa. Thank you for having me today on a Sunday morning to have this very important topic in my view. Thank you once again.
Thank you so much, ma'am, uh, for insightful and highly practical session. Your clarity, real life examples, and simplified GST approach have truly added value to all of us today. We appreciate your time, guidance, and dedication you bring to the educating students and professionals. Thank you everyone for joining. Looking forward to see you in the next session. We will start next session in 5 to 10 minutes. Thank you, ma'am.
Thank you.
Sir, should we start?
Yeah, Vaibhav, sure, we can start.
A very warm welcome to everyone joining us for the next Power Pack session of GSTK Pathshala. We are now move into topic that is extremely important in a day-to-day GST practice, reverse charge.
वैभव तुझा आवाज येत नाहीये. वैभव,
Okay.
गुड आफ्टरनून सर.
Good afternoon, very good afternoon.
Am I audible?
Yeah, you're audible, Vaibhav, I think.
Yes. Okay.
Hello.
A very warm welcome to everyone joining us for the next Power Pack session of GSTK Pathshala. We are now move into a topic that is extremely important in day-to-day GST practice, reverse charge mechanism. And to guide us, we have a dynamic speaker with us today. It is my pleasure to introduce CA Deepak Jain sir, the founding partner of DPNP and Associates, Chartered Accountants, a renowned specialist in GST and indirect taxes. He is widely appreciated for his youthful energy, conceptual clarity, and his ability to simplify even the most complex provisions with ease. DPNP and Associates, established in 2014, has grown into trusted 11 years old firm with offices in Pune and Khopoli. The firm is known for its strong expertise in GST advisory, virtual CFO services,
I think your voice is not audible, Vaibhav. Are you there? I don't think we can hear you. Mr. Vaibhav, are you there? I think some technical glitch. Uh, can you all, Mayur, Shubham, and YP, can you all hear me?
Yes, sir.
Hello. Yes, sir.
Yeah, and Mayur, just assuring that the guys who have joined are there in the meeting. Thank you for the introduction, Vaibhav. I think he's disconnected. So, Mayur, are you there? Let me just confirm the three people who have joined are there with me in this seminar. It's a Sunday afternoon, I can understand. Learning about GST on a Sunday afternoon is a bit difficult, but let's make it a discussion rather than a seminar or a webinar. Shubham, can you all first quickly introduce yourselves? Shubham, YP, I'm sorry, I don't know your name. YP is there on your screen.
Hello, sir.
Shubham, we'll
Good
start with
morning.
Shubham. Can you please introduce yourself
Yes,
quickly?
sir. Yes, sir. Good afternoon, sir. Myself Shubham Kolte. I'm an article assistant at Earth and Associates in my second year articleship.
Great. Thank you, Shubham.
Yes.
Mayur, I don't think Mayur is there. He has joined the meeting, but maybe stuck somewhere else. Welcome, Bhavna. Can you introduce yourself, Bhavna, quickly?
Hello, sir.
All, yeah, please.
I am Bhavna from Navi Mumbai. So actually, this is my first session because the national conference was happening in
Okay.
Mumbai.
Yeah, I know. I'm aware about that. Okay, welcome. So let's quickly run through the session. I'll share my screen. Is the screen visible? Can you all see the screen?
Yes, sir. Yes, sir. Visible.
Okay. Okay. Thank you. Thank you, Pradnya and all the committee members for inviting me for this session. Reverse charge mechanism under GST. It is the most, I think, not complex, but unfollowed segment in GST. So we'll quickly run through First of all, what is RCM now? Normally, what is the forward charge mechanism is the supplier collects the tax from the buyer and pays it to the government. That's how the forward charge happens. Now, what is reverse charge here? Reverse charge is the exact opposite of forward charge, where the recipient of the goods or services is liable to pay GST directly to the government. And not on all the products, there are notified goods, notified services, and first question that came to my mind when I read about this way back in 2017 when the GST was introduced is why RCM? Why RCM is there? Because generally what happens is the recipient who received the services pays the RCM and pays the RCM and takes the credit of it. तो अगर क्रेडिट ही लेना है और पे करना है तो ये इंक्रीज कंप्लायंस क्यों? क्योंकि ये आरसीएम का बेनिफिट ना रेसिपिएंट को पास होता है, ना ही आगे कहीं वो उसका रिफ्लेक्शन आता है. तो व्हाई? द फर्स्ट इज टू इम्प्रूव द कंप्लायंस पार्ट. द इंडिया इज ड्रिवन बाय द अनऑर्गेनाइज सेक्टर. बहुत बड़ा सेगमेंट है अनऑर्गेनाइज का. गवर्नमेंट wanted to include that sector into the arena of GST and prevent the leakage of taxes which is happening due to the unorganized sector. तो जीएस आरसीएम नहीं था, उसके पहले क्या होता था? देवर लैक्स ऑफ अनरजिस्टर्ड डीलर, राइट फ्रॉम द वेजिटेबल सेलर टू अ ट्रांसपोर्टर. बहुत बड़ा सेगमेंट है. तो वेंडर्स भी डिपॉजिट कलेक्ट करते थे जीएसटी पर, डिपॉजिट नहीं हो रहा था. देयर वाज नो डॉक्यूमेंटेशन फॉर द यूआरडी पेमेंट्स व्हिच आर डन, व्हिच आर अकाउंटेड. इट वाज नॉट देयर इन द जीएसटी परव्यू. और बहुत सारे फेक इनवॉइसेस एंड देयर वर लॉट ऑफ फेक इनवॉइसेस थिंग वाज हैपनिंग एंड इट वाज वेरी डिफिकल्ट टू इन्फोर्स द कंप्लायंस एट द सप्लायर लेवल. तो गवर्नमेंट ने जो रिलायबल बिजनेसेस है हु फाइल्ड द रेगुलर मंथली रिटर्न्स, उनके ऊपर ये बर्डन डाला, मेड देम द पार्ट ऑफ द कमिटी लाइक अ टीम, जो उस सेगमेंट को, अनऑर्गेनाइज सेगमेंट को अपने जीएसटी के सिस्टम में ला पाए. सो सबसे पहला सवाल जो मेरे दिमाग में आया था कि व्हाई आरसीएम वर्क्स इवन दो द आईटीसी इज अलाउड. Basically, how it works is you say some URD purchases you make sale, you make the payment under the RCM and take the credit of it in the same month. तो why it is there? Because revenue में government के कुछ भी फर्क नहीं पड़ रहा. There is no increment in the revenue part of the government. The first and foremost thing is they are ensuring the documentation. जो भी यूआरडी परचेजेस है, जो भी अनऑर्गेनाइज सेक्टर के साथ ट्रांजैक्शंस है, मैंडेट द सेल्फ इनवॉइसिंग दैट मेक्स द डॉक्यूमेंटेशन, creating the seriousness that require actual cash outflow before claiming the credit so as to uh, mater- uh, so as to legalize the transactions, legalize the expenses, and eliminating the leakages. Now, purpose, the goal is compliance and the data tracking, not just the revenue collection. Collection is not the purpose behind RCM. The only and only purpose behind the RCM is to documentalize the unorganized sector of the India. Now, how RCM captures the unorganized sector, how it is done even without the supplier GST? क्योंकि जितना भी आरसीएम में कलेक्शन होता है, नॉर्मली द सप्लायर इज नॉट रजिस्टर्ड अंडर जीएसटी. सो जीएसटीएन तो नहीं है, बट उससे क्या होता है, जितना भी ट्रांजैक्शन है आरसीएम का, अनऑर्गेनाइज सेक्टर का, वैल्यू ऑफ सप्लाई, द नेचर ऑफ सर्विस, इंडस्ट्री ऑफ कंजम्पशन, रेसिपिएंट कंप्लायंस बिहेवियर, ये सारा कैप्चर होता है और सिस्टम में इंक्लूड होता है. तो ये स्टेप बाय स्टेप प्रोसेस समझते हैं हाउ आरसीएम इंप्रूव्स द कंप्लायंस. सबसे पहले से आई एम अ रजिस्टर्ड डीलर एंड आई make an expense which comes under the purview of RCM. So first and foremost thing as a registered supplier is I have to make a self invoice. I'm raising a self invoice for every categorized expenses that is done. After making the invoice, I make the payment of RCM to the government. Through credit, it is not allowed. I have to make the cash payment while filing my GSTR 3B. And I maintain a proper RCM register of all such kind of expenses done under which comes under the RCM. I declare that into GSTR 3B and 1 as well if the recipient is registered under GST, mostly in case of transporters. I pay it to the cash ledger and then claim the credit. I cannot claim the credit without paying into the cash ledger. That creates a strong and unbreakable audit trail. This is the step-by-step process how the RCM works. Now, how RCM is helping in gathering the data for the government. Uh, because of the RCM, the unorganized sector is included into the system of GST. The government, the department can track the unorganized UID purchases. They can map the purchases, and even RCM is there. We'll understand this later. Import of services, so they can monitor the foreign currency outflows of such kind of services imports, and they can understand which industry is have the highest industry benchmarks of establishing the input ratios. And this helps in identifying the fake invoices, identifying the frauds, and identifying the anomalies in the input tax credit claims. Basically, the all in all purpose is to convert the invisible economy into a visible database. नाउ लीगल फ्रेमवर्क सेक्शन समझ लेते हैं बिकॉज यू ऑल आर स्टूडेंट्स, सो ये आपके लिए जरूरी है। सेक्शन 9(3) के अंदर नोटिफाइड गुड्स एंड सर्विसेज दिए हुए हैं। The main RCM list comes under 9(3). Section 9(4) covers the URD to RD. Initially, जब आया था RCM, it was applicable to all the URD purchases. उसके बाद एक threshold limit आया 5,000। उसके बाद कुछ और changes आए। Right now, it is only applicable to the notified sectors, notified sector of suppliers. Currently, URD to RD is only and only applicable to the real estate sector. Import of services is always under RCM. Import of services, not the goods. Only import of services. And section 9(5) covers the e-commerce operators. ये सारे sections और ये सारे segments हम आगे individually we will understand each and every segment. Now, key features क्या है? When you collect the RCM, you have to pay it through cash payment only. You cannot set it off with the credit ledger. ITC is available once the cash payment is done, and you can claim the ITC in the same month. उसी month में you can claim the ITC provided you're making the cash payment of the RCM. Supplier cannot charge the GST on the invoice. Now, when you collect the RCM, वो RCM आप supplier को charge नहीं कर सकते. You have to raise a self invoice. See, my company's name is ABC Private Limited. So, ABC Private Limited to ABC Private Limited. Self invoice will be generated for the RCM. No mention of any supplier in this invoice. And the only impact here is you block the temporary blockage of funds until the ITC is utilized or until ITC is claimed. If you have the sufficient output GST is there, I don't think there will be any cash flow impact because of RC. Now, very important part, जो composition dealers है, who pays the GST under the composition scheme, 1% or 5%, whatever, they have to pay the RCM at the normal rate, not at the composition rate. And the most important part is they cannot use the composition tax liability to offset the RCM. Basically, the composition dealer, very important part, composition dealer cannot claim the ITC on RCM pay. So basically, for the composition dealer, RCM becomes a direct cost to business, increasing the expenses and the compliance burden. Basically, composition dealer जो है, वो RCM का credit claim नहीं कर सकते. So वो उनके लिए direct cost बन जाता है because they are not eligible to claim any credit, including the RCM credit. So composition dealer के लिए थोड़ा सा hardship kind of है because उनके लिए ये सीधा सीधा cost है. The RCM deductions. Now, let's come to time of supply for goods under section 12(3). So, liabilities arises at the earlier of the following three. The date of receipt of goods. The moment you receive the goods or the date of payment enter in the books or debited in the bank, or 30 days from the date of issue of invoice by the supplier. say if the supplier is issuing the invoice, only in the case of when supplier issuing the invoices. So a receipt of the goods, payment of the expenses made, or 30 days of receiving the invoice by the supplier. Earlier of these three will be the time of supply in case of RC. Now, in case of services, the थोड़ा सा अलग है services में. Date of payment is there. Instead of 30 days, in case of services, it is 60 days from the date of issue of invoice by the supplier, and book entry. If the invoice date is not available, or if the invoice is not given by the supplier, the date when you enter the respective expense in the books of accounts, that would be considered as a time of supply in case of services. Now let's break it down the RCM segment wise. First comes section 9.3. Under section 9.3, specific goods from agricultural or unregistered suppliers often attract RCM. गुड्स के केस में फॉर कैशो नट्स जो अभी तक नोटिफाइड है, दैट आर कैशो नट्स, बीड़ी और तेंदू लीव्स, टोबैको लीव्स, सिल्क यार्न, रॉ कॉटन एंड लॉटरी सप्लाइड बाय द स्टेट गवर्नमेंट. इतने ही गुड्स आरसीएम के परवे में आते हैं अंडर सेक्शन 9.3, विच आर टिल डेट स्पेसिफिकली नोटिफाइड बाय द गवर्नमेंट. सर्विसेज के केस में जो सर्विसेज अभी तक नोटिफाइड की है डिपार्टमेंट ने, द फर्स्ट एंड फॉरमोस्ट एंड इज द गुड्स ट्रांसपोर्ट एजेंसी. ये हर सर्विसेज का वी इंडिविजुअली अंडरस्टैंड आगे चल के इन द फर्दर सेगमेंट. So I'll just run through the services which comes under the purview of RCM. Is goods transport agency, advocate services, arbitral tribunal, sponsorship service, director services, insurance agent, security services, UID supplier, business correspondence or a facilitator, renting of motor vehicle, some conditions are attached to it, and TDR and FSI in case of real estate segment. These are the services which comes under the purview of RCM. So ये goods है जो RCM के इसमें आते हैं, specifically notified है, and these are the services which comes under the RCM. Now let's break it down.
मैं क्वेरी पूछ सकता हूँ?
Yeah, sure, please.
सर मुझे एक में क्वेरी थी कि लाइक अभी जो स्टेट गवर्नमेंट लॉटरी टिकट्स है वो तो लाइक बहुत लोग परचेस करते हैं, राइट? एंड जब हम कोई भी
आपका आवाज थोड़ा कम आ रहा है.
एक सेकंड सर. ओके, एक सेकंड. लाइक हम जब भी कोई गुड परचेस करते हैं, गुड या सर्विस आरसीएम में, तो हमें मैंडेटरी रजिस्ट्रेशन लेना पड़ता है, राइट?
राइट.
सो लाइक लॉटरी टिकट्स तो बहुत लोग लेते हैं ना सर, बट लाइक फिर वो वहाँ पे रूल क्यों नहीं एनफोर्स करते वो फिर?
बहुत बेसिक रूल ऐसा है कि ये जो आरसीएम अप्लीकेबिलिटी है ना, ये सिर्फ रजिस्टर्ड सेगमेंट के लिए है, फॉर रजिस्टर्ड डीलर, इफ आई एम करेक्टली अंडरस्टैंडिंग योर क्वेश्चन. सो आपका सवाल ये है कि एक मैं नॉर्मल अगर लॉटरी खरीदता हूँ फॉर फ्रॉम एनी लॉटरी डीलर, तो मैं वहां पे वो लॉटरी डीलर को आरसीएम अप्लीकेबल क्यों नहीं है? दैट्स व्हाट योर क्वेश्चन इज, राइट?
यस.
या आई थिंक दैट्स अ ग्रे एरिया. वो होना चाहिए, बट उसका मेन रीजन ये है कि बहुत सारे लॉटरी डीलर्स भी जो है ना, वो जीएसटी के क्या बोलते जीएसटी के पर्वे में अभी तक आए ही नहीं है. रजिस्टर्ड डीलर बहुत कम है. आपका सवाल और आपका जो ओपिनियन है वो सही है कि नॉर्मल लॉटरी डीलर जो रजिस्टर्ड है जीएसटी के अंदर, उनको भी एप्लीकेबल होना चाहिए, राइट? यही आपका सवाल है, राइट? होना चाहिए, 100% होना चाहिए. और ऐसे बहुत सारे और भी सेगमेंट्स है जहाँ पे आरसीएम अप्लीकेबल होना चाहिए, पर अभी तक वो अप्लीकेबल किया नहीं है. उसका एग्जैक्ट रीजन नहीं मैं बता नहीं पाऊंगा, पर मेरा ओपिनियन ये है कि स्लोली एंड स्टडीली गवर्नमेंट इसको इम्प्लीमेंट कर रही है. और सच्चाई है कि बहुत सारे सेगमेंट्स अभी तक इसका कंप्लायंस कर नहीं रहे. देयर आर लॉट ऑफ कंपनीज, लॉट ऑफ रजिस्टर्ड डीलर आर नॉट कंप्लाइंग विद द आरसीएम, एंड अभी अभी गवर्नमेंट ने उनको नोटिसेस भी जारी करना शुरू कर दिए. सो आई थिंक इट विल कम, इट शुड कम, बिकॉज ये सेगमेंट गवर्नमेंट का रेवेन्यू बहुत हैवीली यहाँ से आता है, फ्रॉम दिस सेगमेंट. इनकम टैक्स कंसिडर करें तो, एज फार एज इनकम टैक्स इज कंसर्न, और लॉटरी itself is an unorganized sector. भले ही वो रजिस्टर्ड डीलर है फिर भी, और गवर्नमेंट डज नॉट वांट टू प्रमोट द लॉटरी एज सच, क्योंकि जो अनऑर्गेनाइज या फिर जो स्टेट गवर्नमेंट सप्लाइड लॉटरी डीलर्स जो है ना, उनको ऑलरेडी बहुत सारे कंप्लायंसेस है, तो उनके लिए अभी तक आरसीएम आया नहीं है, पर आना चाहिए। आपका ये ओपिनियन बहुत सही है कि आना चाहिए,
Yes, sir. Okay, sir. Thank you so much, sir.
राइट? या थैंक यू फॉर द क्वेश्चन। लेट्स मूव अहेड। नाउ लेट अस अंडरस्टैंड जो सबसे इंपॉर्टेंट है आरसीएम में, इज अ गुड्स ट्रांसपोर्ट एजेंसी। नाउ फर्स्ट एंड फॉरमोस्ट सेगमेंट जो दिमाग में रखना है इज, हर ट्रांसपोर्टर जीटीए नहीं है। द ट्रांसपोर्टर हु इश्यूज द कंसाइनमेंट नोट is only considered as GTA. If no consignment note is given by the transporter, there will not be any RCM. See, and दो चीजें हैं। If the goods transport agency is charging the GST on a forward charge basis, तो RCM की जरूरत नहीं है। If the goods transport agency in their invoice mention the consignment note number, freight value, the consignor and consignee detail, and most important GST payable under RCM, अगर ये invoice में mention है, तो the recipient will have to do the compliances of the RCM. And even in GTA, there are certain services which are exempt. If the GTA is into agricultural produce, milk, salt, newspaper, food grains, ये सब ट्रांसपोर्ट करा रही है, तो उस केस में आरसीएम इज नॉट एप्लीकेबल। गवर्नमेंट द डिपार्टमेंट हैज specifically exempted those services. If anyone has any questions in this, they can definitely interrupt and ask me in between as well.
No, sir. No questions.
Surely. Let's move ahead. Now let's come. GTA is very simple. Let's break it down. If no consignment note, no RCM. If there is a forward charge, no RCM. If the invoice, the GTA mentions GST payable under RCM, we will have to deduct. We will have to do the compliances of GST and raise the self invoice on the same. एंड इन जीटीएस केस, इन जीएसटीआर 1, हमको उनका जीएसटी नंबर भी डालना, इन सॉरी इन जीएसटीआर 3 भी विल हैव टू मेक द कंप्लायंस ऑफ आरसीएम एज वेल. Advocate and arbitrational services. Now, services provided to any business entity, uh, if they receive any services from advocate or arbitrational services, they will have to do the compliances of RCM. एंड अगर okay, not applicable when it is provided to individuals for a personal purpose or provided to the government. Obviously, it is not applicable at the time because जिसको provide कर रहे हैं will not be registered under GST if it is for a personal purposes. Again, if the advocate is charging under forward charge, then you don't have to do the RCM compliances as well. Director services. Directors of the company receives amounts under different heads. So अगर सैलरी मिल रही है, if it is a director remuneration, तो it is not taxable. It does not come under the purview of GST only. So it is a employer employment relationship में आता है, तो उसमें RCM नहीं आएगा. If the director receives any payment under the nature of sitting fees or any commission or any consulting charges, then the RCM will be applicable. So if remuneration is there, कोई RCM की जरूरत नहीं है because it comes under employee-employer relationship, so no RCM is required. For sitting fees, commission, consulting, or any other payment received by the directors will come under the purview of RCM and the company will have to do the compliances. Imports के केस में एनी इंपोर्ट ऑफ सर्विसेज, कोई भी इंपोर्ट है सर्विसेज का स्पेसिफिकली, दैट कम्स अंडर आरसीएम purview. So the conditions are, if it is supplied outside India, of course, the recipient is in India and the services is used for the businesses. Personal services are again exempt in this case. And common examples of import of services are Google Ads, जो almost all the businesses uses, जिनका clientele abroad है या इंडिया के बाहर है. Google Ads, Facebook Ads, software subscription like Zoom, Slack, Zoho, not Zoho, sorry, Zoho is an Indian company. फॉरेन कंसल्टेंट पेमेंट एंड फ्रीलांसर बेस अब्रॉड, ये जो बेसिक कॉमन एग्जांपल्स है इंपोर्ट ऑफ सर्विसेज के जो आरसीएम के अंदर आते हैं. ई-कॉमर्स ऑपरेटर, ये सबसे बड़ा अनऑर्गेनाइज सेक्टर है राइट नाउ, जिसको गवर्नमेंट ने टैप करने की कोशिश की है। एकदम बेसिक एग्जांपल है, स्पेसिफिक ई-कॉमर्स सर्विसेज आर लायबल टू पे जीएसटी इंस्टेड ऑफ द रजिस्टर्ड अनरजिस्टर्ड सप्लायर। सो जो भी ई कॉमर्स प्लेटफॉर्म्स है, उनको से बेसिक जो कॉमन सर्विसेज है, उबर, ओला, ओयो, एयरबीएनबी, अर्बन कंपनी, any e-commerce operator which supplies which gives the services to the registered supplier, the registered supplier is bound to do the compliances under RCM. अगेन अगर अनरजिस्टर्ड सप्लायर है तो उसको आरसीएम तो आएगा ही नहीं, बिकॉज इट इज फॉर द रजिस्टर्ड सप्लायर्स ओनली। Section 9(4) covers real estate. Under Section 9(4), it is basically URD to RD, from unregistered dealer to registered dealer. Earlier, all the URD purchases above 5,000 were under RCM. After that, in 2019, government notified the businesses only where to comply, do the compliances under 9(4). राइट नाउ रियल इस्टेट इज द ओनली सेक्टर जिनके लिए ये अप्लीकेबल है, और उनके लिए भी एक रूल है, 80% प्रोक्योरमेंट रूल। सो promoters and builders must procure at least 80% of value of inputs and services from the registered supplier. अगर 80% of their inputs and services are from the registered supplier, then there is no need to do the compliances under RCM for the balance 20%. अगर शॉर्टफॉल होता है, if the registered procurement is less than 80%, the builder pays RCM at the rate 18% on the shortfall, not on the entire amount. And cement is specifically mentioned. If the cement is sourced from the URD, it is liable to 28% GST always. Capital goods purchases from URD liable to RCM at the applicable rate. So cement in always under RCM 28%, capital goods always under RCM at the applicable rate. Other than these two things, if the builder procure less than 80% from the registered supplier, the balance amount of the expenses done from the unregistered dealer, it comes under the RCM. This is as far as the real estate is concerned. Now, what are the documentation?
सॉरी टू इंटरप्ट, मेरे एक क्वेरी थी बस।
Yeah, please.
एक्चुअली ई कॉमर्स के केस में अगर लाइक जो वैल्यू ऑफ सप्लाई है, हम वो कैसे डिटरमाइन करेंगे? सपोज एक अमेजोन पे सेलर है, तो उसको अगर अमेजोन ने 10,000 रुपीज़ अगर प्लेटफॉर्म फीस चार्ज की, तो फिर अमेजोन 10,000 पे आरसीएम भरेगा, या फिर जो अपना एजेंट का एक डेफिनेशन है कि लाइक एजेंट के टर्नओवर में लाइक हम जो 20 लाख की लिमिट है उसको असर्टन करने के लिए उसने जो गुड्स बेचे अपने प्रिंसिपल के नाम पे, हम वो भी कंसिडर करते हैं, राइट? सो फिर अगर इस केस में उस सेलर ने अगर 5 लाख के गुड्स सेल किए और 10,000 की प्लेटफॉर्म फीस थी, सो फिर अमेजोन को आरसीएम ऑन एवरीथिंग भरना पड़ेगा या फिर बस उसके प्लेटफॉर्म फीस पे भरना पड़ेगा?
पूरे अमाउंट में भरना पड़ेगा।
ओके, सो 5 लाख मतलब जो सेलर ने उसके थ्रू सामान बेचा प्लस
whatever is the amount of expenses incurred
ओके
by the recipient, उसको पूरे अमाउंट पे आरसीएम भरना पड़ेगा, irrespective of the supplier ahead. Amazon is working as an intermediary, but it is on the entire amount. The RCM will be on the entire amount, and the self-invoicing will have to be done on the entire amount. Because books में अपन उतना expense claim करेंगे.
ओके, गॉट इट सर, थैंक
Yeah?
यू। यस।
Documentation, the basic documentations which the recipient has to maintain is the self-invoicing. Under Rule 46, all the RCM suppliers, mandatory for all the RCM suppliers received from the unregistered person, self-invoicing is the mandatory part. Payment voucher, Rule 52, must be issued at the time of making the payment to the supplier. RCM register, essential for tracking the liability versus the ITC claim. Vendor invoice is only in case where the vendor issues the invoices. They'll have to maintain the vendor invoice register as well. And reconciliation on month-to-month basis is suggested, not mandatory. So these are the basic, the most important part here being the self-invoicing and the RCM register. what are the accounting entries now? There are four steps. One is you book the expense. So when you book the expense, you debit the expense account and credit the supplier account. When you book the RCM liability, RCM tax will be debited and the RCM payable account, which will go under liability, will be credited. When you make the payment of RCM, the RCM payment account will be debited and set it off, and the cash ledger will be credited. And when you claim the ITC, the input tax credit will be debited and the RCM tax account will be credited. Basic accounting entries for the RCM here. Now, let's come to the reporting part. The first thing is GSTR 3B reporting. So, under GSTR 3B, Table 3.1D, inward supplies liable to reverse charge. And the liability side, the RCM will be mentioned under Table 3.1D. And on the asset side, the ITC Table 4A3, inward supply liable to reverse charge other than input. ITC must be paid via electronic cash ledger, which I already mentioned, and ITC can be claimed in the same month after the payment is done. So you can claim the ITC in the same month itself, provided the payment is done through cash ledger. Under GSTR 1, it is the supplier's liability. Now, GSTR 1 reporting only for the suppliers who are registered dealer. For example, GTA advocates, if they are registered dealer and they are not paying the GST under forward charge, then they must report the outward supplies liable to reverse charge under table 4B of GSTR 1. And this automatically populates in the recipient GSTR 2B, which directly comes in 3B as well under the respective table. So clarification is GSTR 1 reporting is mandatory for supplier if registered, which I already mentioned. And for UID purchases, reporting happens via 3B, recipient and internal self-invoicing for the UID purposes in cases where the supplier is unregistered. Here, these are a few practical examples. GTA is Goods Transport Agency. Say supplier is a GTA form. Recipient is a registered company. Of course, the recipient will pay the GST. If the registered private limited company takes any legal services, supplier is advocate, they'll have to pay the GST under RCM. For software import, a supplier is a US company, recipient is an Indian tech company. They'll have to do the RCM compliances, the Indian tech company. In case of security services, supplier is a UID agency, recipient is a registered business, then the registered business will have to pay the GST under RCM. There are certain segments or certain businesses for which RCM is not applicable. RCM exemptions, agri GTA. So transport of agri products, milk, salt, food grains, pure services to government, fees, penalties, RTO charges, certain public utilities like toll charges, electricity, water are exempt from the purview of RCM by the department. Okay, so next part is common mistakes जो होती है, some certain common mistakes and their solutions. So the registered supplier recipient, usually RCM is paid but ITC is not claimed. They pay the RCM but ITC under 3B claim करना रह जाता है. So उसके लिए the solution is maintain the monthly RCM register and do the reconciliation. Even if ITC is missed in this month, you can always claim in the next month also. And the basic confusion is director salary versus the fees. So maintain a proper HR record, proper employment versus professional records of the director. Self invoice missed. Common problem hai. A lot of businesses do not maintain the self invoices. You have to use maybe certain AI tools for this. There are a lot of softwares available for this, which automatically maintains the monthly RCM invoices in the accounting software, and you can always download it from there. Wrong GTA classification is one more problem. Uh, First of all, check whether the GTA issues the consignment note. Verify if the GTA is opted for a forward charge. If they are charging the GST and the forward charge, you don't have to do the RCM compliances. You can always take the credit of the GST charged by the GTA. And one more common mistake is you claim the ITC, से जीटीए है, जीटीए ने अपने जीएसटीआर 1 में दिखा दिया, तो वो अपने जीएसटीआर 2B में रिफ्लेक्ट हो जाता है, एंड यू क्लेम इट इन द 3B, बट यू फॉरगेट टू forget to pay it by putting into the table 3.1. So this is the common mistake. uh, इसका solution है claim only after the liability is discharged in cash. और एक और है, अगर उस मंथ में नहीं क्लेम कर पाए, सो यू कैन ऑलवेज क्लेम इट इन द फर्दर मंथ्स, बट देयर विल बी इंटरेस्ट लाइबिलिटी अटैच्ड टू इट, एंड यू कैन ओनली क्लेम अप टू द पीरियड स्पेसिफाइड विच इज 30th नवंबर ऑफ द नेक्स्ट ईयर. सो से मार्च 2025 का कोई आरसीएम मिस हो गया है, you can only claim up to a certain period. Maybe in the GST audit also you can reflect it, but you'll have to pay the interest on it. Okay. What if you don't comply with the RCM? अगर RCM के compliances नहीं किए, तो what are the consequences? Number one being the interest on 18% on the charge delayed RCM payment. RCM पेमेंट यू कैन मेक एनी टाइम, बट आरसीएम की लाइबिलिटी आप अगले साल के 30 नवंबर तक ही ले सकते हो. अगर आपने वो मिस कर दिया तो यू स्टिल हैव टू पे द आरसीएम, बट यू विल नॉट बी एबल टू क्लेम द क्रेडिट ऑफ इट. So this is very important part. And right now government are issuing a lot of show cause notices under section 73, 74 for non-payment of RCM liabilities. And even the ITCs have been blocked if the documents and invoices, the self invoicings are missing during the scrutiny. Uh, Time limits, I already mentioned. ITC can be claimed up to 30th November of the next financial year. Liability can be paid any time later, but you'll have to pay 18% per annum interest on it. ये मैंने ऑलरेडी आई थिंक आई हैव ऑलरेडी कवर्ड इट. क्लेम्ड इन द लेटर मंथ, यू कैन क्लेम द मिस्ड आईटीसी इन द सब्सिक्वेंट मंथ सब्जेक्ट टू द 30th November deadline. You can maintain a proper ledger, RCM ITC receivable ledger in your Tally software or in Excel as well, or there are a lot of AI tools available for this. And even for reconciliation, there are AI tools, there are softwares which automatically reconciles the 3.1D liability with 4A3 credit annually. I think more or less this is all about RCM. It's not a vast or a big topic, but a lot of confusions are there in it, which I think more or less I've covered everything. There are certain questions which I had prepared, but I can see only 5 people have joined in. So we'll avoid that and let's jump to the Q&A round. So if you have any questions, you can ask. Let me summarize it. The RCM compliances is important for the registered dealer, for the notified goods, for the notified services. And if you don't do it, there are consequences, and the consequences may lead to interest, may lead to penalties as well. You can may also lead to blocking your ITC credit. So that is all. I think let's jump to the questions. I'll stop my screen. More or less, I've covered everything, basics of RCM. So if you have any questions, you can ask. Otherwise, we'll wind up the session. Yes, any questions?
No, sir, not at the moment.
All right, then I think that is all about RCM. Thank you, Pune branch of WIRC, for inviting me in this seminar as a speaker. Thanks a lot. Thank you, Vaibhav, for the coordination. And I don't think Pradnya is there. Thanks, Pradnya, for calling me for this. Thanks a lot. Yeah, over to you, Vaibhav.
Uh, Thank you so much, sir, for delivering such a clear, insightful, and high energy session on reverse charge mechanism. Your practical approach and real-time examples made the concept incredibly easy to understand and truly enrich today's learning. On behalf of Pune Vikasa, we deeply appreciate the time and expertise you shared with us. Thank you once again for your guiding us with such excellence. Also, thank you to all who have joined the sessions. Thank you so much.
Thank you, Vaibhav. Thanks a lot.
Yes.
Thank you.